This is their main reaction function at a time when they're not going to get that far away from 0% interest rates.
For balance sheet watchers at the Federal Reserve, you can book a seat on the Lisa Brammer's tour at 4:30 Eastern on Thursday afternoons.
Exciting.
Lisa Brammer's, Tom Keene, Jonathan Ferro. I wasn't joking, that's what Lisa does on a Thursday afternoon at 4:30.
Everyone knows that.
How big is the balance sheet now? Equity futures up 3 on the S&P, advancing 0.07%. On its Payrolls Friday, more insight from some wonderful guests, including Bill Dudley, the former New York Fed president, who'll be joining us shortly. Your equity market just a bit firmer, near all-time highs. From New York, this is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. Senate is set tomorrow to approve that $550 billion infrastructure package. It would be the largest infusion of cash in decades for roads, bridges, and other domestic projects. The bill still faces challenges in the House. Speaker Nancy Pelosi has said she will hold on to the bill until the Senate also acts on President Biden's largest spending plan. And the U.S. probably enjoyed a hiring spree in July. According to economists surveyed by Bloomberg, today's jobs report is likely to show the U.S. added just about 858,000 jobs last month. The rollout of vaccines has encouraged businesses to reopen and consumers to return to shops, restaurants, and bars. And more than 30 U.S. trade groups have called on the Biden administration to resume negotiations with China and remove tariffs. They say those levies are hurting the American economy. The trade groups include influential organizations such as the U.S. Chamber of Commerce. Public universities in the U.S. face student lawsuits over coronavirus vaccine mandates. According to the Dow Jones, lawsuits challenging the vaccination requirements have been filed in Indiana, Connecticut, California, and Massachusetts. Students claim they have a constitutional right to go to college unvaccinated. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
see a lot of price increases in the short run. The key question is, are those transitory or are those sustained? I think we're going to see them transitory for a while. I don't think they're necessarily going to be sustained over the 1 to 2 year horizon.
Great to catch up with Randy Krosner there, the University of Chicago Booth School of Economics professor and former Federal Reserve Board member from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Friday morning, it's Payrolls Friday. 858,000 is the estimate in our survey. Futures going into that +3. We advanced 0.07% on the S&P 500. Bond yields are higher by 3 or 4 basis points. Had a little look at 126 earlier this morning. 125.66 right now. And WTI, Tom, let's round it out with crude, reclaiming a 70 handle at $70.11. We're back up by about 1.5% this morning.
Yeah, it was a good signal of this global slowdown fear. Don't really know what to make of it. I would note Swiss 20-year, which I mentioned, John, has recovered a little. European yields. But to me, John, it's all noise. Don't you agree?
Oh, totally. It's all noise until we get to the payrolls report. Noise. And Tom, even if I told you the data right now, would you be able to tell me how the market would respond?
Well, I'd fake it like I do in the media every day. But no, the answer is
and I would join you. But at this point, Tom, I'd have no idea.
Let's go to somebody who has absolute certainty on what's going on in Washington. Emily Wilkins joins us. Emily, almost heaven, West Virginia. Mr. Manchin set off a comment on Chairman Powell, but far more importantly is what the senator from West Virginia is facing at home, which is constituents and inflation. Explain that tone in Washington of all these different fancy people in suits and ties and their constituents saying, look, here's the non-transitory here and now.
So there are two narratives right now at battle in D.C. One of them is that inflation is a huge problem, that the Biden administration needs to get in gear addressing it. And the other narrative is that, yes, inflation isn't looking good right now, but it's just the economy coming back online after COVID. Give it a few months and everything's going to shake out and be fine. Now, obviously, the White House is in favor of that latter narrative, and they're hoping that most Democrats go with them. But we are beginning to see fault lines with, as you mentioned, Senator Joe Manchin writing that letter to the Fed saying, hey, you guys really do need to start addressing inflation going forward. And this could play into that upcoming debate. I mean, we've all been focused on the bipartisan infrastructure bill, as we should. But remember, this is a dual track process. We have that $3.5 trillion reconciliation to consider, and that could be stymied if there are these inflation concerns.
You've drank the Kool-Aid. I get the inside the Beltway thing. How many other Joe Manchins are out there that are saying almost heaven Missouri inflation or almost heaven Idaho inflation? What's the tone that agrees with Joe Manchin?
Well, right now, it's mostly hearing from Republicans who have concerns about inflation. And those Republicans are not going to be voting for this $3.5 trillion reconciliation. We knew that from the start. Question is how many Democrats agree with Joe Manchin. And there's definitely the potential that there could be more, particularly if we continue to see inflation rise the way that it has and maintain this very high level. There are a number of moderate senators, Kirsten Sinema, John Tester, who could potentially join Manchin in saying, hey, we're not really sure about passing this $3.5 trillion spending package.
Well, first we have to get past the $550 billion bipartisan infrastructure bill. There's a vote this weekend. My favorite quote in the story about that on the Bloomberg is from Dianne Feinstein, California Democratic senator, as she left the floor on Thursday night. Everybody's in a bad mood in there. How tense is this? What's going to happen? What's the main point of dissent that people are going to be arguing about this weekend?
Well, look, no one likes having to stay at work late, especially if you're a U.S. senator. The arguments that they have at this point are about a couple of amendments. Last night, they were hoping to pass this big package of amendments, finalize the bill, and then get everyone home. But that got held up by a freshman senator from the state of Tennessee, so that did not happen. A couple things left dealing with cryptocurrency. How wide or how narrow should regulations be, as well as whether or not states should be able to use some funding from allocated for COVID-19 to go towards infrastructure. So that would wind up being a bit of a pay-for there.
I'm sorry, not to cut you off, but cryptocurrency, how does that fit into infrastructure having to do with rebuilding America? Connect the two, cryptocurrency regulation.
No, it's a great point, and it's a pay-for. The idea is that they are trying to still, at this 11th hour, find things and ways to pay for this infrastructure bill. And you heard them go through numerous ideas. You've heard them looking at selling off petroleum and oil reserves, of delaying a Trump-era regulation that never went into place in the first place. I mean, I think you heard Bloomberg news reporters kind of say it quite well in one of their stories. They wrote that this is the federal government equivalent of looking for change in couch cushions.
Emily, is there any difference between legislative policy making, sausage making, budget expansion in a Biden government versus a Trump government? The answer is it's going up.
It has. It absolutely has. And to a certain extent, when you talk to Democrats about sort of the amount of federal spending, they're very quick to point to that 2017 tax bill that was passed under a Republican House, Republican Senate, and Republican White House that Democrats say, and it has been shown, has added to the federal debt and the federal deficit. So there's definitely been spending on D.C. on both sides of the aisle here. But when you are the party who's not in power, as the Republicans are right now, you do tend to oppose things that majority is doing, and one of the arguments they are using right now is that spending argument.
Emily, thank you. Good to hear from you. Emily Wilkins, Bloomberg Government down in Washington, D.C. Tom, loving the John Denver drop there. Just dropping some lyrics.
Did I do that okay?
Nice. That was beautiful.
Yeah,
You could describe the White House, couldn't you? Life is older. Life is old there, older than the trees. Something like that? No, you don't want to go there?
No, I'm not.
You don't want to play?
I'm
Don't fancy
not
it?
going to launch
Okay,
into John Denver.
I'll get to the price action. Equity futures up 3 on the S&P, up 0.07%. What has stopped you before? Yields are higher by 3 basis points. There we go. Younger than the mountains, growing like a breeze. 125.33 on 10s.
I love that going
Yields
to a
higher by
market check.
3 basis points.
That's
Go on,
like
Lisa.
that's like being put in the corner. It's like time out.
On this show, that is time out.
That is time
That
out.
is time out.
Literally.
Look at this
You've done
tweet,
it,
John.
Tom.
Would you translate this tweet,
I'll
please?
do my best if you get the
Please,
tweet
I
up for me to
have no
see. What
clue.
tweet?
On radio, this is this iconic tweet where like the guy's looking at the other girl while he's walking with his girl.
That classic
and
meme.
Michael has gone out here and done a Tottenham thing for John and I. John, Harry Kane is with the guy.
The attention's all on Messi. So the media attention has turned to Messi and away from Harry Kane.
Is that what that means?
That's what's
For
happening.
those of you on radio, it's Greek to me.
And I wonder, Tom, if Manchester City are looking at their plans right now and wondering whether they want to get in here and get Messi to Manchester City and maybe avoid Harry
Seriously,
Kane.
John, are there other Manchester cities out there to support their TV revenue?
To be honest with Tom, there's only 2 clubs that can really afford the wages here. And one's Paris Saint-Germain and the other's Manchester City. They're the only 2 clubs that I can think of that can get it done. The other outsider may be Chelsea, but apart from that, that's about it.
Really? And the Tots aren't part of that?
No, your Tots are not part of that conversation, unfortunately, Tom.
How about Preston North End?
You've got to try and hang on to Harry Kane. Preston North
he's
End.
gone. Right,
John Riding's Preston.
Seriously, John.
That is not part of the
Stop,
conversation.
stop non-farm payrolls.
Stop
Harry Kane is
non-farm
like
payrolls.
not gone?
Not yet, no. Grealish apparently has. Do you want to continue this in a commercial break?
Probably not.
Get on the naughty step. Get on the naughty step. The S&P up 3. We advance 1/10 of 1%. From New York City on radio, on TV.
Jobs report
This is Bloomberg.
has been looking at West Palm. They have been looking at outside of New York for offices. How are you thinking about your footprint as people return to the office and want to work from different places?
Yeah, so it's the new Apollo. I think flexibility is the name of the game. When it comes for us in our business, I think that we've really preached the mantra of flexibility. I think we've proven throughout COVID that we could be highly effective. In fact, if you look at the bottom line, I think more effective than we've ever been in our history through a flexible work environment. So as we head back for the fall, we've really preached to all of our businesses to lean in and embrace this flexibility and go where the market goes. We're in a competitive industry. Our portfolio companies are in a very competitive labor environment. And I think businesses that just want to go back to the way things were are missing a huge opportunity to learn from what's gone on over the last 18 months.
Had an exceptional Q2. It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Live from New York City for our audience worldwide on TV and radio, good morning to you. Here's the price action this Friday morning. Equity futures positive 0.06% on the S&P. Record highs coming into Friday on both the S&P and the NASDAQ. The NASDAQ just a touch softer, lighter, lower by 18 on the NASDAQ 100. We're down by about 0.12%. We switch up the board. It's the fear of a May repeat. The April jobs report. We looked for 1 million. We got 266. We looked for 858 today, and we wonder what a big downside surprise would mean for this market. Tom, you brought this up. I think the price of the story matters because when we had that jobs report, yields, as you pointed out, your 10-year was 158. Your 10-year right now is 125.33. So what do you believe, Tom? A really hot ISM or a really soft ADP?
I believe we got to get away from the minutia that the media is focused on. I think, frankly, everybody at Bloomberg's doing a real good job of that, of trying, John, to look at the larger picture and link together what's on the Bloomberg terminal. I would suggest equities speak volumes.
Let me tell you what I believe. Switch up the board and finish on this. I believe, like so many people believe, there is a ton of demand in this economy right now.
All jolts. You're just
and we struggle to find the supply. So these are job openings in America, and Tom Keene, they are sky high. And this is the question for August, for September. Going into that September 22nd meeting, Tom, will we have some evidence that supply is starting to meet that rock-solid, robust demand?
Yeah, for those of you on radio, Farrow channeling Michael McKee here with a jolt of the jolts. And, John, this is really important. The number of jobs that are out there is stunning. I mean, it's basically unmeasurable.
It speaks to that fantastic demand we have in America right now, Tom. The big unknown is how quickly supply will heal for the year still to come, for the several months we have left. Will prices get it done? Tom, we can talk about that with Alan Zettler and Morgan Stanley in just a moment. Let's get you some movers. Let's cross over to Bloomberg's Romain Bostic. Hey, Romain.
Hey, good morning, John. We have some breaking news crossing the wire right now. This on United Airlines. United Airlines is going to require all of its workers to be vaccinated. This will take effect in late October, and it coincides with what United is saying is going to be an update to the FDA's guidelines here on the vaccine. Remember, the vaccine approvals out there right now are for emergency use, which raises a lot of questions about people who have medical conditions. It is expected that the FDA will move to make that approval basically a full approval. Basically means it's safe for everyone, and United says that means all of its workers need to have that vaccination. It already says about 90% of its pilots are already vaccinated, and about 80% of its flight attendants. It wants 100% basically by the end of October. There will be some exceptions if documented for medical and religious reasons, but this is the first major airline to do this, and it is expected that the other major airlines will follow. Keep an eye on that. that space. Also keep an eye on the rest of the travel space as well. We did get earnings out of Expedia yesterday. They were good overall. The problem, of course, is that there's a little bit of a slowdown here, and the buy-side analysts that we talked to seem to want to see a little bit more aggressiveness with regards to guidance. This is the broader story going on right now in the travel space for the airlines, for the hotels. Things are great right now, but the sustainability of this is certainly in question, as well as, of course, all of the concerns about the Delta variant and how both workers as well as customers are going to be protected. Novavax at the top of your screen, those shares down 10%. Interesting story there. Of course, we know they had a very good trial with regards to their COVID vaccine. The problem is they still haven't submitted for approval here in the U.S. The problem is that their manufacturing guidelines don't quite meet FDA standards. They're pushing back their submission for authorization till the fourth quarter. That's at least the second delay that we've seen out of Novavax. Flip up the board, a few other names just to keep an eye on this morning real quickly here. DD shares getting a little bit of a bid here. Some news here that they may be finding a way to comply with the latest regulatory issues there over there in China. FireEye and the cybersecurity stocks down here as well on a slight miss, as is mobile gaming company Zynga.
Romaine, thank you so much. Greatly appreciate it. On this Jobs Day, Ellen Zentner joins us from Morgan Stanley. Thrilled that she could be with us today. Ellen, how's your x-axis changed? Our great debate at Surveillance is the idea of a boom economy back to some normal. Tell me about your 21, your 22, your 23, and the American labor economy.
Yeah, so I think it's going to be a slow slog back for labor force participation. I mean, we saw a drop of more than 3 percentage points, which has never happened in history. Labor force participation can decline, but I think 1 percentage point was the historical biggest number, and then it can take years to climb back to pre-downturn levels. And so it's just going to be a slow slog. We're going to get some bumps here and there. And so one of the upside bumps we're expecting is, as John said, around, September, August, September, as schools are reopening fully and more people can go back to work. So you'll get some positive bumps there. But I think it's going to take quite some time for normalization in labor force participation rates. And that's, of course, going to dampen how much economic growth you can get. Now, we still have a lot of stimulus in the system.
Right.
And we still got more legislation to go. And so the economy is slowing sharply next year, but still growing above its potential. But I think, as you said, look out to 2023 and beyond.
Right.
It won't be difficult for the economy to fall back to a one handle if you don't get more participation.
Okay, the one handle is unthinkable. I mean, the basic idea here, and this is almost a global central bank question, Ellen Zentner, the idea that we can stay accommodative longer runs up against a massive pressure to right the ship sooner rather than later. How do you judge that right now with a Powell Federal Reserve? Are they going to be sooner or are they going to be later?
Well, I think the first step, of course, is tapering their asset purchase program, and then they're moving toward that. I mean, that has a lower bar for starting that program than actually raising rates. They have to see substantial progress to taper. They have to actually have arrived at their goals in order to raise rates. They're moving toward tapering. And I think, John had mentioned what would be a payroll number that would really shock the markets. I think it would have to be below 500,000, possibly as much as below 300,000. Wow. For the Fed to believe that we're not making the kind of progress that they would like to see. But we're getting there. Now, when you finish tapering the balance sheet, only then will they turn and start discussing when do they hike rates. And the thing about their new framework is that implicit in the framework is you delay rate hikes, and then when you do begin to hike rates, you do so only gradually. The real neutral rate of the economy, jargon alert, will be rising by the time you're getting out to 2023. Even if you're moving down into a one handle on GDP, potential GDP is somewhere around 1.5%, 1.7%. So you can still have a tighter economy enough, lower unemployment rate enough that you can start to raise rates slowly. It's just a sensitive economy that you're not going to be able to raise rates quickly. I don't believe in that narrative.
Can you explain to me a political system, John, that can accept a 1% growth rate?
Right now, for a president and an administration that wants to do something about the labour market and do a whole lot more. Ellen, you've just posed a really tremendously difficult conundrum for this Federal Reserve. If these supply constraints persist, how the Fed can respond to that. Let's just say they persist into the new year. What does this Federal Reserve do, Ellen?
So, John, it depends on just how much participation has changed. Has it changed structurally? I mean, I think one thing that the Fed has been looking at and that we've been following closely is that the rate of retirements has been soaring, and much more so than demographics would suggest. It's very easy to point to that cohort and say most of them are not coming back, even if you have a strong economic growth backdrop. But others that make up about probably two-thirds of the drop in labor force participation are for other reasons, and if you have a very strong economy, you can bring those back. And so it has been critical for the Fed to remain accommodative, coupled with very stimulative fiscal policy. It's when we get out into 2023, if you've still not seen the pickup in labor force participation, if it looks much more structural than anyone had imagined, then you can, it can bring the Fed to redefine what does maximum employment mean to them. Yeah. And it could signal much more inflationary pressures than the Fed would have thought at that point.
Ellen, we just have about a minute left. You've been one of the most accurate jobs market forecasters going forward. One reason why is because you look at high-frequency data. Right now, what is the high-frequency data telling you about how the Delta variant and fear of the spread has put a crimp in the labor market and progress there?
Yeah, Lisa, so it is critical to bring those into our forecasts, even if we're judging it from a qualitative perspective. I think if I'm concerned about today's payroll report, it would be there have been signs more of late that you've got a slowdown in some of those mobility data, the daily data that we get. And we have an AlphaWise team that produces large-scale surveys for us, and our latest consumer survey did show that that vaccines, that people have topped out in terms of the rate of folks that are getting vaccine, but that the concern over the Delta variant surged, and that's just in the last 2 weeks. So self-policing will come back as a jargon alert again. Self-policing, which leads to more cautious behavior and can dampen some of these this business activity and further reopening.
Ellen, just quickly before you run, what's the number again that you and the team are looking for?
We're looking for just above a million, 1.025. We're near the top, John.
There we go, 1.025. Ellen, thank you. Wow. It's good to catch up as always. Ellen Zentner and Morgan Stanley, the chief U.S. economist. Always tremendous to catch up with Ellen on Payrolls Friday. They're looking for 1.025. The estimate today, Tom, 855 the average, the median 870.
May 7th. That's all I got to say, John.
Is that what you think, Tom?
I'm completely humbled by this natural disaster that we're in. John, you and I and Lisa see it anecdotally in the 3 zip codes we frequent. All of our viewers and listeners see this across the nation. It is not normal economics.
Most people in this market remember May 7th. For those of you tuning in that do not, May 7th was the April jobs report. Lisa, we were looking for 1 million. We got 266,000. This week's been confusing. ADP report was really soft. ISM was really, really hot.
This time is different, though, in terms of the vaccination rates and in terms of the reopening, at least that I feel, walking through Midtown, walking through different neighborhoods in New York City. It does seem like people are coming back to some sense of normalcy.
Price of this market's different. 125.66 on 10s against pushing 160. Back when we had that read. Your equity market, futures positive 3, advancing 0.07% on the S&P. From New York, alongside Tom Keene, Lisa Abravitz, I'm Jonathan Ferro, on radio, on TV. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. United Airlines says workers must get vaccinated against the coronavirus. It's the first major U.S. carrier to impose the mandate. United says employees must upload their injection record to a company database no later than October the 25th. The Senate is heading towards a weekend vote on its $550 billion infrastructure legislation. Senators huddled on and off the floor to discuss final changes to the bill, which is 2,700 pages long. Even if the bill is passed, it faces an uncertain future in the House. There are growing signs a coronavirus Delta variant risks slowing the pace of the U.S. economic recovery. Some events, like the New York Auto Show, are being cancelled due to virus concerns. Meanwhile, Bank of America says a pullback in credit card usage could partly be due to the surge in cases. And Bloomberg's learned that China's DD Global may give up control of its most valuable data. It would be part of an effort to resolve a Chinese regulatory probe into the aftermath of its controversial IPO in the U.S. The data is key to both the business of the ride-hailing giant and the Chinese economy. Byron Trott doesn't like being called the billionaire's banker. Now it turns out he is a billionaire banker. According to the Bloomberg Billionaires Index, the founder of BDT Capital Partners is worth $3.6 billion. The firm now manages $26 billion, and it's taken 2 companies public this year. Trott has advised some of the world's most successful investors, including Warren Buffett. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
How do you assess the sector as a whole? Is it making a better case for itself at the right price at this point?
Most of the big hedge funds, most of the people that have been growing, have been delivering very good performance. We have, but so is a number of the peers. You know, it is definitely the hedge fund business is getting more about the large getting larger and generating more performance, being able to hire the best people, thereby generating better performance, thereby getting larger. So when you look at the performance of the largest, say, 20 or 50 hedge funds, the performance has been pretty good over a number of years, and the inflows have been pretty good. You know, this is another quarter of positive inflows for us. I think one of the bits you're seeing at the moment is every client is worried about inflation. When they say they're worried about inflation, what they really mean is, I own a load of bonds, is that going to cause me a problem?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
It's never been this unrewarding. You know, and 2, 3, 4 years ago, people were asking me, are we in a high-yield bond bubble? And I would say, no, we're in a bond bubble. Interest rates were low, which means that prospective yields were low. Today, we're in an everything bubble.
We are in an everything bubble. The words of legendary investor Howard Marks of Oaktree Capital, the co-founder and co-chairman. From New York City this morning, good morning. Alongside Tom Keene and Lisa Bramwitz, I'm Jonathan Ferro. Futures +2 on the S&P. We advanced 0.06%. We are 42 minutes away from the payrolls report in America, and yields are higher by 3 basis points to 125.50. Tom Keene, your estimate all over the place, somewhere between 850, 870 going into the print.
Here's where the agreement is, and John and Lisa and I, well, we rarely agree. We get in a room once a year, and part of our agreement is we have to do a real yield brief every Friday to get Farrell ready for his afternoon soiree. We do that now with the former president of the New York Federal Reserve System, of course, with Goldman Sachs for years. William Dudley joins us this morning. Bill Dudley, you are focused entirely on the land of John Farrell, which is the real yield. How do we get out of the conundrum that Mr. Marks just described?
Well, the conundrum is by intent. The Fed is buying assets, and by buying assets, they're forcing people to hold more deposits than they want. Those deposits earn zero, and so the response to that is to buy bonds. Negative real yields now are touched minus 1.2% last week. In the past week, that's the lowest on record, going back to the 1990s when TIPS were introduced.
Yeah.
So it's a pretty interesting environment where real yields are hitting record lows at a time that the economy is in recovery, and inflation on a year-over-year basis is at 5%. It doesn't really fit together very well.
You mentioned the word intent. I'll bring in will as well. Bill Dudley, the key thing here is the mystery over the will and intent of the good people at the FOMC in this original moment. What would you suggest is their will and intent into the end of the year?
Well, I think their will and intent is to make financial conditions very accommodative, to provide as maximum support to the economy, to get all the people that are unemployed currently because of the pandemic back to work. You know, they've talked about making substantial further progress towards their goals of maximum sustainable employment and price stability. They basically told us they've made some progress, but they haven't quite satisfied that substantial further progress yet. And depending on what the payroll employment report is today and maybe next month, maybe they'll have satisfied that requirement, and then they'll start to begin the taper process.
Bill, demand is robust. It's really good. Big question is, will supply arrive? That's where the hope is at the Federal Reserve. Do you share that hope, that faith that supply arrives and the participation of this workforce will recover to where it was?
Well, we're going to find out a lot in the next couple of months when schools go back into session and the unemployment compensation benefits end. Right now, we have a bit of a tension between what we're seeing in terms of job openings, record job openings, and what we're seeing in terms of the labor markets. It's still a big shortfall of employment relative to where we were in February 2020.
We've been talking all week, Bill, about the fact that the Fed probably is not going to materially shrink its balance sheet. This is one of the reasons why you attributed yields as being as low as they are. You said that they should be higher. It is for the Fed's participation in the market that they are as low as they are. Do you agree? Do you think that the Fed is going to keep its balance sheet either at this pace or higher for the foreseeable future, just based on where we are economically and based on where we are with respect to the low interest rate regime?
Well, they're hoping they're going to be able to gradually shrink their balance sheet, but there's 3 steps. First, you do the taper, then you lift short-term rates to a reasonable level, let's say 1.5% or so, and only then do you actually start to run the balance sheet off. The balance sheet is huge right now, so one, it's going to take a number of years before we even start to run off the balance sheet, and when we do it, it's going to take a long time to get it back to a normal level.
What's the consequence of having an $8 trillion Fed balance sheet for the foreseeable future or higher?
Well, I think it basically means that there will still be downward pressure on yields until the Fed Reserve ends the asset purchases and then begins the runoff of the balance sheet. And this does put downward pressure on long-term interest rates, no question.
Bill, if you were still at the Fed, what would you say to Governor Waller after his speech this week? What would you say to him? Would you reach out privately, get on the phone, send an email? What would you do, Bill?
Look, I think it's a tricky situation for the Fed in terms of getting the timing exactly right, and reasonable people can differ about when it's time to pare back the rate of asset purchases. I think the big wild card here is the Delta variant and how that's leading to a rise in coronavirus cases. Payroll employment report we're going to get in a bit is really looking in the rearview mirror. That's where we were in mid-July. Real question is where are we going to be 2 or 3 weeks from now?
Dr. Dudley, Mr. Farrow has been impolite, so I'll go even worse. Let's go to Lawrence Meyer of Washington University at St. Louis and his wonderful monograph, a short little book on Alan Greenspan. I do think seriously, Bill, that many of our listeners and viewers really don't understand the process that this chairman goes through with the good people around him, including the vice chairman from Columbia University. How is the Powell decision-making tree different from what Lawrence Meyer described as the Greenspan dominance?
Well, I think it's more of a consensus-building process. People talk about the big three, the chair of the Fed, the vice chair of the Fed, and then the vice chair of the Federal Open Market Committee, the president of the New York Fed, John Williams. Those three get together frequently and discuss what's the appropriate course of policy, what should the FOMC statement look like. So it's not just one person setting policy. It's the three people sort of driving the process forward. And then, of course, you have to bring the other members of the FOMC along with you.
Bill, your insight's valuable, and I'm looking forward to the latest column coming out a little bit later this morning on Bloomberg.com and, of course, on the Bloomberg terminal. That was Bill Dudley there, the former New York Fed president and Bloomberg opinion columnist. As we wait for payrolls, Tom Keene, 36 minutes away.
36 minutes away. And again, John, I'm going to go back to equity dominance here with the VIX 17.12. The VIX improves this morning. All in all, John, I'd say the tape modestly improves. And what Ellen Zentner said there, you need 500,000 or so non-farm payrolls to really shake up the system there. That's a little bit below some of the other analysis.
I'm going to go to the get back to work effort, and United Airlines taking it one step further.
Yep.
Lisa, they were asking Newhart a couple of months ago to provide proof of vaccination, and now they want the full workforce to do the same by October 25th. Get it done.
It's fascinating to see how different the approaches are of different corporations with respect to either mandating it or trying to encourage with $100, or if Tom had his way, $1,000. In the meantime, I just want to point out, do you think that Rich, John, and Jay have their own table at the Fed that they sort of
Rich,
sit?
John, and Jay.
Yeah, that they like sit at and sort of click on the Federal Reserve.
Very informal and casual.
That they
sit away from people.
This is, they sort of get together on their own. They're kind of,
like
the cool kids.
The back of the school bus.
Yeah, they're kind of the cool kids that, make the decisions.
Don't go down there and talk.
Exactly. I mean, because they're the ones that are sort of the big three making the decisions.
And President Bullard's down the front causing trouble.
He's the one throwing spitballs.
This is real value-add stuff.
I try.
Coming up in the next hour, Jill Carey-Hall of Bank of America Securities, JP Morgan's Jim Glassman, Jeff Rosenberg of BlackRock. It's the big countdown to the payrolls report, 35 minutes away. 850, 860, 870. It's all in and around that kind of number. That's the estimate. Looking forward to full coverage right here on Bloomberg TV and radio. With equity futures up 2, we advance by 0.05%, and your 10-year yield in and around 125, 126. With Tom Keene, Lisa Bravitz, Jonathan Ferro on radio, on TV for our audience worldwide. This is Bloomberg Surveillance.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Friday is Jobs Day.
For every positive thing you point to, there's something less positive.
The June report fell short of estimates.
The unemployment rate goes up to 5.9%. It's one of those things where you say it's good news. The unemployment rate goes up.
What should we expect to see from July's report?
A lot of reshuffling. We'll continue to see hiring at large pace.
Are people looking to return to the workforce?
Businesses have a lot of jobs to fill. They can't find workers.
The July jobs report, Friday on Bloomberg Television and Radio.
The economy, the empty cubicles that you've seen across the country, it has not stopped.
We've been waiting for the supply to pick up, and supply is exploding.
We've taken wealth from the public sector, and we've given it to the private sector.
We're going to see a lot of price increases in the short run. The key question is, are those transitory or are those sustained?
Now it's time to sort of pull back both the fiscal as well as the monetary stimulus.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Jobs Day. In this hour, we will look at the American labor economy, what it means for bonds. Jeff Rosenberg with us, what it means for the economy. Jim Glassman of J.P. Morgan, and what it means for this stock market. John, the markets will react.
Equities record highs, Tom, on the S&P 500, the NASDAQ record highs over in Europe through the week as well. Demand is really strong. Will supply arrive? That's the big story. It's mission get back to work. And to what degree, to what extent are the Delta variant fears, Tom, derailing that process?
What I see in the tape, what's actually happening, as Subhana Rajappa mentioned at SocGen, the gloom and doom, John, is overdone.
125 overdone in the bond market.
Come back a little bit.
Negative 1.2%. Real yields overdone in the bond market. Tom, here's the issue. How many times have you and I heard that over the years? The yields are too low, and then they keep going lower.
And talking to Bill Dudley there, former president of the New York Fed, he's thinking very much about getting the real yield back. The dislocations in the market, Lisa Abramowitz, are part of not only this jobs report, but the one coming up for August.
And the idea, not only with the headline number, but some of the details. And it was interesting to me that Ellen Zentner of Morgan Stanley really focused on the broad aspects of this employment report, in particular, wages and participation rate. On the wage front, just want to bring you this headline out of the Dow Jones Newswire. Walmart is giving weekly bonuses to keep its warehouse workers. How much are some of these headlines, these anecdotes, going to play out in hourly wages going up at a pretty dramatic pace in this latest report?
Really well said. And also the United Airlines headline. We'll get to that in the hour. So much to go on right now. And what's so important, folks, about this hour on radio and television nationwide is it's about the markets, the bond market, yes, the American economy. And John, again, the stock market, how they react.
Let's get to the stock market right now on the S&P 500 coming into Friday. Record highs right now, up a couple of points, +2. We advanced by 0.03%. We've walked you through the bond market. 124.99 on 10s. Had a little look at 126 earlier in the session. Yields higher by 2 or 3 basis points. Euro dollar negative. The euro weaker, dollar stronger. Euro dollar 118.03. Crude just south of 70. Had a little look at a 70 handle earlier in the session. 69.86 right now. And here are the numbers you need to look for in about 27 minutes time. 870. 870,000 is the median estimate. And the range, how many times have we done this year? The range is wide, wide, wide. 1.2 million at the high end, 356K at the low end.
Home on a range. Here's a number I care about, and it goes to the real yield. See it this afternoon on Bloomberg Television. Negative 1.10 on the 10-year real yield. That is an artificiality all of America must deal with. All corporate officers must deal with that, which of course means the stock market. Jill Carey Hall starts us strong in this hour with Bank of America. What is your Standard & Poor's estimate a year out, Jill?
So we're at 3,800 on the S&P 500 for year end. So we are expecting that the market will end the year lower rather than higher. And I think, a lot of the good news has really been priced into the market this year. I think it's been about earnings coming through, which we've seen this earnings season, another really big beat so far. But multiples are very elevated on the index. The sentiment indicators that we track have been growing increasingly bullish, and our Wall Street equity sentiment measure is very close to a sell signal. And I think earnings season suggests that a lot of the good news has been priced in. Companies that beat just aren't outperforming very much, which we saw last quarter. And outside of the last 2 quarters, the last time you saw that happen was around March of 2000.
Jill, you, Savita, and the team looking for a down market then. Walk me through the sector preference within that call.
So, we still like some of the cyclical areas over defensive. So we're overweight energy, we're overweight financials. I think where interest rates are right now, we would expect them to move higher rather than lower. And we still like value over growth. I think from especially with the jobs report this morning, I think wages are going to be a very important metric to continue to watch. So we're underweight some of the more labor intensive areas like consumer discretionary, where, so far for the S&P 500, margins have generally held up, but this earnings season, you are seeing a big surge in companies mention, labor and wage pressures, where that had been one of the more benign sources of inflation prior to this. So I think a lot of the areas of the market that have a high ratio of employees relative to their sales are going to be some of the areas that, could be more challenged as we move forward if wage inflation continues to accelerate.
Jill, you and the team have done some tremendous work on that, and I've enjoyed reading the research, so thank you. Thanks for providing it. The call for value over growth, I want to understand from your perspective whether there is a bond market call that underpins that view. What is the bond market call, if there is one, that underpins that view?
Well, look, I think there's a number of things, and really what we found is that the profit cycle has been a bigger driver of value versus growth than interest rates. So, really you want to own value when growth is becoming more abundant within the market. Profits growth on a trailing basis is still accelerating. And, the value stocks within the market are actually slated to see better earnings growth over the next 2 years than growth stocks. So, you don't need to pay up for expensive growth if growth has become more abundant and actually better within the value segment of the market. And these value stocks are still generally cheap and under-owned relative to growth stocks. So, I think there's a number of drivers that can even be more important than interest rates in terms of owning value over growth right now.
Jill, you haven't mentioned the Delta variant at all, even though that seems to be mentioned in every other article about the market trend so far. That has seemed to put a crimp in some of the cyclicals and some of the small cap names that I know you track so well. When do you start to care about the Delta variant? I mean, is it impacting your appreciation for some of these stocks, or do you think that this is actually a buying opportunity?
Well, look, I think it's a risk that we're all going to continue to monitor, and there's a lot of uncertainty around it. But I think from a reopening and recovery perspective, there's certainly been pockets of the market where we've seen this grow to become more of a concern. But in terms of other areas, leisure, the overall services spending recovery, I think that's something that we're going to be watching the data very closely on as we move forward. But overall, as we progress throughout this recovery, smaller stocks are obviously more exposed to the reopening, to the shift from goods to services spending, and they haven't really reflected much of that recovery at all. So they've still been trading at this double-digit historical discount to large cap peers, even though they're slated to see a better earnings recovery and have more exposure to some of these reopening trends. So the margins for small caps this earnings season have also still been accelerating despite the pressures from inflation. So I think there's more room to run on small versus large. They've given up their outperformance year to date on some of these concerns, but I think it's going to be something that warrants continued monitoring going forward, and is one of the biggest risks certainly for the market.
We're starting to hear from other Wall Street shops that they are starting to project out to the end of 2022. Have you done that? Does this down market continue through then, as people have brought forward so much of the earnings ahead of the cycle?
Right. So we don't have a 2022 target yet, but when we've looked at, what's the best predictor of very long-term S&P returns on a multi-year basis, valuation doesn't tend to be a great predictor over the next, year or so. If you're a longer-term investor thinking about equities over, the next decade, that's where, returns from our long-term valuation framework are going to be, much lower than what we've seen by our frameworks than, prior years, just given the fact that multiples are so elevated right now. So, if you're a long-term equity investor, you're going to see much more tepid annualized returns for equities than we might have seen a number of years ago. So, when you add a dividend yield onto that for the S&P 500, we still favor equities over bonds at this point, but certainly that asset allocation decision has grown, less skewed toward equities than it was a number of years ago.
Jill, thank you. We've got to run and get ready for that payrolls report. I know you have too. Jill Carey-Hall, Bank of America US equity strategist, looking for 3,800 on the S&P. They're looking for a down market. This S&P 500 right now, all-time highs into Friday. We're positive, 2 points on the S&P, up 0.05%. Mohammed Al-Arian just publishing in a Washington Post, Tom, an opinion piece. Here's the headline. The Fed's ultra-loose monetary policy could hurt both the economy and Biden's agenda. I'll catch up with Mohammed in about 50 minutes' time.
These are the back and forth, the cross currents, John, and you say to yourself, how do you go from Costin at Goldman Sachs over to what Jill Carey's talking about at Bank of America? The gap there between Bank of America and Goldman Sachs, you can drive a Mack truck through that.
It's a 900-point spread, Tom.
Yeah.
On S&P 500
I mean,
year-end
people
forecast.
are going to go, wait a minute, explain that.
There's
explain
5 months
it,
left. I can't explain it for you, Tom.
but
Lisa, there's 5 months left.
Lisa can.
There is an explanation, and they've got divergent views in interest rates. And a lot of the Goldman Sachs call was underpinned by this belief that rates would remain low. If you believe that rates are going to remain that much lower, that's not going to upset the apple cart when it comes to equity valuations, especially with a slow growth economy in the longer term.
I would go further. I would say not only is it a rate differential call, but it's a nominal GDP differential call where Goldman Sachs is looking for some animal spirit in 22 and on, and Bank of America has a much more cautious view.
It's where they think the earnings will show up. And you heard that from Jill there, Lisa.
Well, the earnings will show up, but also there's a question of we don't understand Treasury yields. They have continued to go down despite all of the calls for them to go up.
I said this in a previous hour, and I know the two of you agree. If I could tell you the print, and I do not have the print, the White House has the print. If I could tell you the number that was coming out in 19 minutes' time, could you tell me how this bond market would respond?
Absolutely not.
Not many people can do that with the degree of confidence, and that's where the confusion lies. 125 on 10s, yields high by 3 basis points. Your equity market up 3, plus 3. We're positive 0.06%. Positive 0.07. Did you say something, Tom?
Dow futures
from New York. It's a beautiful morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. Senate is set tomorrow to approve that $550 billion infrastructure package. It will be the largest infusion of cash in decades for roads, bridges, and other domestic projects. The bill still faces challenges in the House. Speaker Nancy Pelosi has said she will hold on to the bill until the Senate also acts on President Biden's largest spending plan. United Airlines says workers must get vaccinated against the coronavirus. It's the first major U.S. carrier to impose the mandate. United says employees must upload their injection record to a company database no later than October the 25th. And public universities in the U.S. face student lawsuits over coronavirus vaccine mandates, according to Dow Jones. Lawsuits challenging the vaccination requirements have been filed in Indiana, Connecticut, California, and Massachusetts. Students claim they have a constitutional right to go to college unvaccinated. Singapore will take advantage of having one of the best vaccination rates in the world. The Southeast Asian Trade Center announced plans to ease COVID restrictions on daily life. It also will begin slightly loosening border controls. 2/3 of Singapore's population is now fully vaccinated. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
you grow the health business?
After the crisis of COVID-19, everybody is very concerned about health, in particular when it comes to the question of how do you get very fast access to the health system, how do you have a very good health coverage given that illnesses have increased, pandemic signals have increased, and certainly longevity is still increasing. And so AXA as an insurer can really help to gain access to the system, to find the best doctor possible, and to help the patients as quickly as possible. And we see that this is very much on the rise.
How does the spread of Delta, especially in the U.S., and just the threat of more variants, how does that complicate and impact your outlook?
It is clear that in the very short term, we are all very confident.
Had an exceptional Q2. It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
Particularly, sort of technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
You're living in a world of excess supply, and therefore what you need to do is you need to create the liquidity that allows inflation rate to actually not get sucked into a deflationary bias. And this has been the Fed's ongoing risk.
It will take about a second after that payrolls report drops to have a debate about what the Fed will or won't do next. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. We are 12 minutes away from a payrolls report in America. Your equity market looks like this, up 2 on the S&P, plus 2, positive 0.05%. Outside of that, yields are higher by 2 or 3 basis points on 10s to 124.99. Euro dollar negative, down to 118.07. Tom, we're looking for something like 870 now.
Yeah,
870
please.
Is the median estimate going into the jobs report.
Stay with us on radio and television. It's going to be an eventful number of hours. The Secretary of Labor with John Farrell will do that at the 9 o'clock into the 10 o'clock hour. John, before that, Dr. El Arian with that important Washington Post essay.
And Rick Reeder as well from BlackRock. So
Yeah.
we'll catch up with Mohammed, we'll catch up with Rick, and we'll ask them basically the question that led to that essay from Mohammed today in the Washington Post. Will this data that we're starting to see over the last few months, inflation more specifically, overwhelm the goals of both the Federal Reserve and of this administration too?
Let's tie it in right now off the El Arian essay where he talks about a busted price mechanism because of a Fed and their original strategy. James Glassman joins us now with J.B. Morgan Chase. This is a lovely tradition with his true expertise on the labor economy. Jim Glassman, do we have a busted wage mechanism?
We have a lot of dislocations that are making it very difficult to read. I think you don't really know what's going on. When you have 8.5 million jobs shy of where we need to be, a lot of those jobs are folks who work, lower pay or who work in the hospitality and leisure. I think it's really difficult to make sense of it. What I hear from people though is I think the legacy of this crisis is going to be giving more benefits for workers. Pay is going up, overtime will go up. It's getting harder to find people. You're having to pay more for them. It's also forcing you to automate more. This is, to me, the legacy of this crisis is going to be this step forward in labor productivity and pay.
If we have an increased labor share, does that come from leadership from big companies? What is the mechanism to get the wage up?
You know, it's smaller businesses are going to be struggling the most because they're going to have to work harder to find people. And I hear that story a lot in calls with clients. I think it comes from everywhere. Everybody is feeling this. Everybody is experiencing the shortage of workers. This did not happen overnight. This has been brewing for a good decade. It's related to the demographic shift going on in this country. And I think this is going to be a more favorable story in the years ahead for workers than it has been for 2 decades. Because for 2 decades, all that innovation that moved us from brick and mortar to online really has pushed the share of income going to workers down and the share going to profits up. And that's really the dynamics that's been driving a lot of this national debate about the income divide and the widening distribution of income. I think what's going on now is beginning to shift that and stabilize it.
Jim, there's so much to unpack. You were talking about entering an era of increased productivity with more automation, and I wonder how this fits into the low participation rate that just has remained stubbornly low and frankly has been in a downward trend for the past 3-4 decades. Do you expect the participation rate to continue to go lower, people remaining out of the workforce permanently as some of the more rote jobs get automated and skills are increasingly important?
You know, right now, the decline in the labor force has really been exacerbated by this crisis because particularly hit women more than men. You got responsibilities at home. I think, though, this trend that you're talking about, this for the last couple of decades, this is a structural thing that's been going on, and it's got to do with the aging of the workforce. For example, people who are working age, 16 to 70 years of age, we used to see 200,000 a month. It used to be growing 200,000 a month. Now it's down to 50,000 a month, and that's telling you there's a huge demographic. People are retiring. A larger percent of the population, maybe 30% now, is over the age of 55. A decade ago, it was 20%. So that is a huge change, and we normally ignore this as economists because immigration tends to fill the gap. If we don't have the people for the jobs, we tend to get immigration, and we are not seeing that in the last decade.
Jim, before we let you go, I would love you to weigh in on the point that Mohamed El-Erian was making in this Washington Post column, where he's saying that at this point, the Fed maintaining such an easy policy, the fact that they are maintaining their bond purchasing program as is, despite some of the hot numbers that are coming out, is actually counterproductive, and it potentially could even hamper the agenda of the Biden administration and, frankly, the economy. Do you agree?
No, I agree with the Fed. I think they are doing the right thing. We've got 8.5 million jobs to go to get back to normal. That's where their focus is. And if we can't get people back to work, it's going to create even bigger problems down the road. So I think the Fed's got the right idea. I understand it makes everybody nervous when you see the Fed buying assets and keeping rates low when the economy is making progress. It is making progress, but we still have a long way to go when you look at things from the point of view of how much employment do you need to get everybody back to work?
Jim, we've got to run. It's got to catch up. Jim Glassman, JP Morgan Chase Commercial Banking Head Economist. You know how this works. At 8:30 Eastern, the number drops and we go to one man. That man is with us now, Bloomberg's Michael McKee. Morning, Mike. Let's go through these numbers, the numbers that you're looking for in about 7 minutes.
Well, the consensus is 858, but as you've mentioned earlier, the dispersion really wide from 350,000 to 1.2 million. Steve Stanley at Amherst Pierpont makes a very good point that our models are basically designed to look at the demand for labor, but this is a supply of labor problem, and it's really hard to figure out how many people are going to be out there that match up with the jobs that are open. So it's going to be interesting to see how the markets react to that.
Michael McKee, the heart of what Jim Glassman just said, with decades of experience, is this is a permanently changed labor economy. Do you believe that, and does the Fed believe that?
Yes, I think both of us do. It has been changing for quite a while because of the participation rate as the baby boomers retire out. But this accelerated that movement now. And baby boomers are the people who are going to be at the higher levels, who are going to be the higher skilled, who are going to be the higher paid. And, and except for you, everybody's quitting. So
thank you.
It's going to be harder to fill some of those jobs.
Going there, Tom,
John, this is
the
third time we've heard this in the last 90 minutes. Zentner, Glassman, McKee.
Yeah, and I wonder if we'll hear it from Jeff Rosenberg of BlackRock. He'll be joining us shortly. With 5 minutes away, Lisa, 870,000, that's the estimate.
And the question is, how much does this matter in the scheme of things? How will the market respond? What's the threshold for the Fed caring, right? I mean, is it enough to get one payrolls report like this without necessarily seeing the effect of the Delta variant and what might happen in September to say the Fed's going to taper?
I said earlier, it's the most important jobs report since the last one until the next one. The next one is September 3rd. And Tom, September 3rd, we'll have this conversation all over again. What does it mean for September 22nd?
Well, we're in a natural disaster. John, the most important thing today is you had that JOLTS chart up.
Yeah.
Which is a McKee chart. And the fact is that's the dislocation of this economy.
Demand is stellar, it's robust, it's great, it's tremendous. Will supply arrive? Let's run through the price action as we beat the drum a little bit harder going into payrolls. Your equity market up 2 on the S&P 500, positive just 0.04%. Into the bond market, yields higher by 2 or 3 basis points to 124.99 on 10s. Your estimate, 870,000. The previous number, 850K. From New York City this morning, good morning. For our audience worldwide, with Tom Keene, Lisa Abramovitz and Jonathan Ferro, the payrolls report in America is up next.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance, and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What were the numbers from the equities division? How well did it do?
Well, first 28% decrease as compared to a very, very good Q2 in 2020 is a good resilience, and it's a decrease that is much smaller than the one we have seen with some competitors.
Here comes the payrolls report live from New York City for our audience worldwide this morning. Good morning. Your equity market unchanged. Your bond market yields are higher. 124.99 with the jobs report. Here's Mike McKee.
All right, John, we are seeing 943,000 jobs restored in the month of July, which is extremely good news, better than anticipated. Those who had the 1.2 million high end are closer than those on the low end. The unemployment rate declines by 0.5% to 5.4%. Now, I'm going to have to look that up and see why that is, if it's a labor force thing. But it is good news that we see that. The average hourly earnings are up 0.4, which is more than anticipated. That is a 4% annual rate, and we saw revisions to the last 2 months that go up as well. So more money, more hours, and more people working. The change in private payrolls, 703,000, a little bit less than we saw in the prior month, and a little bit less than the anticipated amount. So what I'm guessing is we have a seasonal factor in education here. I will check that out, but maybe you take a quick minute to answer the question Lisa's been asking all morning of how the market's going to react to this.
Well, let's get straight to that market action. Mike, thank you. It's an upside surprise. 943. We were looking for 870. Futures are positive. We're up by about 7 points. We're positive 0.16% right now. The bond market's where you get a repricing. Yields were higher. They're even higher now by 4 or 5 basis points on 10s. We get a 127 handle this morning after seeing 112.58 earlier in the week. If we can have a little look at the FX market, Tom, euro dollar back through 118, 117.95. Tom, we're down there by a third of 1%.
There was almost a pause and then jump started it, not right at 8:30, John, but I'm really watching 30-year bond to see what it does at a 191 on a path to 2%. John, we've done 1.881 million jobs in 60 days. That's how I would look at that with that robust revision.
The yields are higher, the curve is steeper. Mike McKee, straight away, you know how this works. The number drops, and then everybody says, what does it mean for the Fed? Mike McKee, what does it mean for the Fed?
Well, I'm just basically working through some of the numbers here that are important to the Fed, and you look at the unemployment rate dropping as much as it did, and then we look at the unemployment rates for blacks and Hispanics because the Fed focused on that. In June, black unemployment was 9.2%. It drops a full percentage point to 8.2%. Hispanic to 6.6% from 7.4%. That would strike one as substantial further progress. When we look at back to February of 2020, black unemployment was 5.8%. So it's still elevated, but it's come down an awful lot from where it was.
Mike, I know you haven't a chance to dive into it because you're talking and I'm looking, but median duration plummets. This is the duration out of jobs plummets, Mike, to 15.2 weeks from a 19 level earlier. Those are the kind of numbers that give the people under Chairman Powell, the PhDs, some confidence.
Yeah, now the issue is this is 1 month, so they're going to say, let's see the September numbers. But yeah, you get a number like this, some sort of numbers like these in September, then that September 22nd meeting could be the taper announcement. That's what we're going to be looking for, I think, at this point. That's probably what the market is going to price. I don't know, you were looking at the bond market. I don't know if you had a chance to look at the futures yet, but for Fed funds, but I bet we're going to start to see that move in a little bit from the end of the year.
And actually what you're seeing right now in the 2 years, you're seeing a pretty a bigger move there than perhaps in the 10 year as people bring forward the potential for rate hikes, but it's not that big of a move. It's actually surprisingly muted considering the fact that so many people put so much emphasis on what the Fed does. I'm looking at hourly wages. I find this fascinating. Hourly wages increased more than expected, and year over year, a 4% increase in hourly wages versus the expectation for 3.9%. The average hourly work week actually increased as well. How significant is this? All metrics point to more hours and more pay.
Well, there's two things with the average hourly hours worked. That is all that average hourly earnings multiplied by the extra time at work, so more money coming into the economy. Interesting note here, we see that leisure and hospitality led the increase in jobs, 380,000. Bars and restaurants up 253,000. Tom doesn't have to wait as long to get his drink this time. Those are the lower paid jobs. And so if that many lower paid people are coming into the labor force, it should depress earnings, and yet earnings are going up at a faster pace. So it does show companies employees are paying up to get people back to work.
John, quick data check before we get to Jeff Rosenberg. I'm looking at a bond market that picks up steam here, higher yields.
Yeah, that's where the action is, Tom, because equity futures aren't doing much at all. We're up 3 or 4 points on the S&P, barely a tenth of 1%. Right. Yields are higher. The curve is steeper. The yields are higher on a 10-year by 5 basis points to 127. Tom, it's an upside surprise. 943, 870 the estimate, and some really tiny revisions as well.
Lovely revisions. Jeff Rosenberg joining with BlackRock. And what's so important here is holistic and fixed income and doing wonderful work in multi-strategy as well. Is it a regime change today, Jeff Rosenberg, when you see the revisions, when you see 1.881 non-farm payrolls over 60 days, does it shift the BlackRock view?
You know, it's a really good question, Tom, because I was thinking the exact same thing, that, you know, we've had a lot of kind of negative surprises, you know, focused really on the Delta variant. You know, it's important to remember that this payroll report is really pre the CDC mask wearing change in guidance. It doesn't really incorporate some of those more recent changes. Yet, to the extent that we follow the pattern that we've seen in India and the UK, where the variant surges, but it's not a permanent surge, you know, we could be seeing kind of the peaking of the negative news that has been really about the second derivative and the slowdown, and that's manifested itself in a pretty protracted rally in interest rates, you know, since interest rates peaked at the beginning of March. I think the next focus here, and you were just talking about it in terms of average hourly earnings, Mike McKee spot on. It's really hard to digest and decouple the mix shift from the underlying data, but it's a strong print even with the mix shift that Mike was highlighting, and that's really going to turn the focus on inflation. If we add labor market strength, and let's be clear, this is a very strong report across all metrics. There's very little that you can point to here that's disappointing. And if we add to that, you know, some signs of a broadening out from that inflation that we're seeing in the wages here, you know, this could be that regime shift in terms of the direction that we've had on interest rates that you were asking about.
Jeff, if the Fed meeting was tomorrow, what would they decide?
Well, I think you hit it, or someone talked about the taper discussion. You know, it's important here. The Fed is very focused to separate the interest rate tightening path from the tapering discussion. And so when you look at that bond market reaction, and earlier, you know, we were talking about the 2-year versus the back end of the curve, still a pretty muted response in the very short maturities of the Treasury market. The actions in the back end of the curve, and that tells you that, you know, the market is separating the path of tightening from the pace or the calendar on tapering. I think, you know, if anything, it pulls forward maybe tapering, but the Fed's being very clear they want to avoid the taper tantrum. And remember, the taper tantrum was about the market conflating tapering with earlier tightening. This is not going to be an earlier tightening, but it could be an earlier tapering.
And Jeff, that's exactly what President Kaplan tried to do this week, aggressively de-link his commentary about QE from any kind of idea about hiking rates anytime soon. Mike McKee, I want to bring you back into the conversation. Is there reason to believe that this can persist? These jobs gains can persist into September? And was this a stress test for the theory that if you remove additional unemployment insurance, the workers will show? Some people have made that argument. I don't hold a position here. I'm just wondering, Mike, is there proof of that this morning?
No, there's no proof of it this morning. We don't have data that show that. The research that has been done suggests there has been no effect from it overall. In about 2 weeks, we'll get the state employment numbers, and we'll see if any particular states that cut off unemployment benefits see a rise. But one thing that may be at work here, John, is that in the summertime, schools are never in session. So the daycare issue may have not been a problem in the sense of the seasonal adjustment that is done, because they expect people to be out of the labor force to a certain extent taking care of their kids. And let me also mention that the education component that was expected to add to jobs certainly did. Jobs in education, 223,000 more non-seasonally adjusted. So they've added 223,000 jobs to the total. Otherwise, we would have had 720,000. So definitely a major seasonal adjustment question here. But the issue is, does anybody at the Fed really care about seasonal adjustment when they're trying to think of whether it's substantial additional progress?
Jeff Rosenberg, as an investor, what do you do with this information?
Well, as we talked about, I think this is a possible shift here in the rate dynamic. We really have to follow this up with some inflation data if that's really gonna be the case. But just going back to the labor market piece, because you look at what's driving the Fed and market expectations around the Fed, and it's labor markets and it's inflation. And on the labor market side, this is certainly contributing to accelerating mostly the taper discussion. I think the Fed's going to do a lot to try to separate out taper from tightening, and I think that's the main takeaway. I want to just add that there is some little piece of information here that participation rate did tick up 1/10. That's quite helpful. We're going to be focused on that participation rate as we roll off the rest of the unemployment insurance to see whether the supply side starts to ease and you start to see the labor market grow from that end.
Jeff, does this report change the balance of risks with respect to overheating in the economy or perhaps going into more of a stagflationary environment?
I don't think it does. I mean, I think that you've had that balance of risk. Look at Clarita's speech from a couple of days ago, and I think the balance of risk that he highlighted is to the upside on inflation. And while that, there's certainly hawks and doves both within the Fed and within the market, I think that balance of risk to higher inflation is something we had before the report, but certainly this report, particularly, what Mike highlighted on average hourly earnings, only reinforces that risk on the balance of risks being towards higher inflation.
John Farrow, Jason Furman with a blistering tweet. He's never seen a more constructive report like this. He calls it a wonderful set of data. Neil Dutta is heated that this is a massive start to Q3.
It's what we all wanted to see. Jeff, it's good to catch up, sir. Jeff Rosenberg of BlackRock. These are the numbers. If you're tuning in a little bit late, where were you? 943,000, the number. 870 was the estimate. It's a tidy upside surprise and a really nice upward revision as well over the last couple of months. In the market, this is what it means. It means NASDAQ futures are lower by 1/3 of 1%. S&P 500 futures are firmer by about 1/10 of 1%. And the why lies in the bond market, doesn't it? Once again, that's what we've been queuing off over the last couple of months. Your 10-year yield up by about 5-6 basis points, approaching 128 on 10s at the moment after having a look at 112, Tom, earlier in the week. That's quite a turnaround.
We got to stay forward here. I'm going to dovetail this report and what we see right into the Ellerian essay in the Washington Post. I mean, it's not that he has to modify the essay, but he may be even more strident about a need for Fed action.
And that's the conversation I'm going to have, Tom, at the top of the hour. Mohammed Al-Erin of Queen's College, Michael Collins of PGIM, BlackRock's Rick Reeder, Anastasia Amoroso of iCapital Network, the best liner worldwide to get a reaction to the payrolls report. That show starts, Tom, in 17 minutes' time.
We're going to continue the Secretary of Labor to be with us later in that hour as well. Michael McKee, I want to go to you with a sea change here. And as John mentioned, is it a Fed meeting that's changed and all that? Buried in this report are two reports. There's non-farm payrolls, and there's a completely different report. In the old days, I remember David Malpass was the only one that paid any attention to us. What does the household report say versus the more popular non-farm payrolls?
Well, it does give us an answer as to why unemployment fell as much as it did. We didn't see a huge change in the civilian labor force, 261,000. Last month was 151,000. So it isn't that many more people coming in and looking for work, but it was a lot more people getting work. The number of people who got jobs, 1,043,000, whereas 782,000 fewer people reported being unemployed. So this is the exact thing you want to see in terms of good news for unemployment and why that happened. Also, in terms of employment, we saw as I said, 1,043,000 come back, get jobs in the household survey. They had declined last month. That had declined last month, so a nice rebound there. So overall, the household picture, very good. And of course, the household survey includes people who are self-employed, gig workers, people like that, which the establishment survey doesn't show.
Yeah. You know, I want to just double down on the average hourly earnings year over year, an increase of 4%. We've been talking about this since the report came out. But really, if you strip out some of the disruptions that were compositional in nature over the past 15 months, this is the highest read in decades in terms of wage inflation. At what point does this really start to matter to the Fed? Are these numbers clean enough for this to indicate, yes, pay is going up, and yes, this will bleed through into underlying pricing in a material and sustained way?
Yeah, we're going to need a lot more information, Lisa. Obviously, as I mentioned, because the jobs coming back are lower paid, there is something going on. But is it a one-off? Our companies basically spending more money to get people back to work, and then they stop raising pay. That's what the Fed would be concerned about. And a lot of what people are getting is one-time bonuses to come back that won't recur. So we don't know yet whether there is a wage component to a wage price spiral. We know that prices are up. The Fed doesn't think that will continue, and we don't have the evidence yet on whether wages are going to continue.
And Tom, can I just say that actually there was an article in the Wall Street Journal showing that when they gave these one-time bonuses, existing employees said, hey, what about us?
Yeah.
So you started to get bleed through raises and compensation to everybody, because otherwise people would leave. So it does have a bleed through effect, even if it's just a one-time thing.
Well, you saw that in the Vanguard bond show where they do 1,000 for unvaccinated and 1,000 for vaccinated.
Oh, you noticed.
As well. Michael McKee, thank you so much. Much more from Michael McKee through the morning as he dives into this data. Gina Martin-Adams now on the equity market consequences. Gina, I see a churn to equities, but nevertheless, a VIX that signals a bull market. Neil Dutta at Renaissance suggests this is a bang-up start to Q3. How will that change the Standard & Poor's estimate game?
Yeah, I think that analysts are still pretty cautious, frankly, on the outlook. And certainly what we've seen over the course of the last 6 weeks or 8 weeks or so is a rotation into more defensive strategies, really driving the market higher. So to the degree that we have much faster than expected growth and persistent growth, those two things are very important. If we get both of those over the course of the next several quarters, we're going to continue to see upward estimate revision. So far, analysts are only revising estimates higher because second quarter numbers beat. And that's been consistent throughout the entire pandemic. Analysts are very cautious with respect to the outlook. And even though numbers are still going higher, they're only going higher because companies are telling them that they should go higher. It's not that analysts are getting overly optimistic. So if we continue to see numbers like this, we're going to see upward estimate revision all the way into 2022.
How is use of cash changed, or your guesstimate of use of cash? Robert Schiffman published moments ago of a 40 billion share buyback at Microsoft. They've got the powder to do that, et cetera, et cetera. In all of Bloomberg Intelligence, how has use of cash changed to sustain this bull market?
Yeah, so far this year, it's been all about buybacks and M&A. Those two things have really been the dominant factors behind cash utilization by companies. So to the degree that they're willing to part with their cash, which is still a limited amount of companies doing so, they're spending it on re-engaging in buybacks that they cut in 2020 and increasing buybacks over time. They're also buying companies. We are seeing M&A trends improve, and we've seen that really since 2020. What they're not doing so far, and I think where we have the greatest potential to sustain a longer-term, faster pace of economic recovery, is capital spending. Companies are still not parting with their cash in the most optimistic method, and that is spending it on future business potential outside of buybacks and M&A. So we've got to see capital spending improve. There's certainly capacity to do so, just to get back to average share of capital spending relative to sales. We should see CapEx rise 25% over the course of the next 12 to 18 months.
Yeah.
If we get that kind of figure, that's going to increase the confidence that analysts have and certainly increase the durability and the perceived durability and rate of growth that we likely are going to see over the course of the cycle.
Gina, stick with us. We're just sort of parsing through the numbers. Michael McKee is looking at the more granular aspects of this report. And when we talked about the dissonance between corporate earnings coming in so much hotter than people had expected, yet economic data lagging behind, perhaps the economic data just hadn't caught up with itself, Mike. What are the details?
Well, we're looking at revisions to the prior months. So you add in the numbers that were added back for June and May. 938,000 jobs were created in June. We had thought that was 850, so a significantly better report for the month of June, and total 119,000 over those 2 months. So job creation has been a lot stronger than we had thought it was. We had some reports we thought were disappointing. Turns out they weren't as bad.
Meanwhile, Gina Martinetta still with us, and I'm looking at the action in the equity market in response to this. Pretty much as you would expect, NASDAQ futures way underperforming the S&P, which is basically flat. NASDAQ futures are down a little less than 0.5%, or they were in just a couple minutes ago. I'm wondering, from your perspective, if the NASDAQ can post gains through year end if Treasury yields continue to rise.
Very unlikely. At least they will lag. The NASDAQ should certainly lag the S&P 500. The more cyclically oriented, sort of value-centric segments of the market should rise faster in an environment where rates are rising and inflation expectations are rising. In my mind, the recovery that we saw in the NASDAQ and big cap tech in particular over the course of the last couple of months was really about analysts and investors generally getting a little bit more cautious about the growth outlook. So if you continue to have surprises on growth, you continue to have surprises on inflation numbers, that trade depletes over the course of the rest of the year.
Gina Martin Adams, thank you so much. Too short a visit this morning. We now go to Bloomberg Intelligence. Ira Jersey, just wonderful in the short-term trust market, but also out bills, notes, and bonds. What kind of move, Ira, is a substantial move now for this bond market? Let's use the 30-year bond, 1.91, 7 basis points, 1.93. Where does it click in that this is price down, yield up?
Well, I think it has to be for the 30-year back over 2%. I mean, 2% just a number, like 205, 206 is actually a more important technical level here. But I think importantly, and one of the things that the jobs report does show is that we are making some progress. And is this substantial? And the answer to that actually is no, because when you look at the what I call the paycheck of the economy, so you look at aggregate labor income, that's hours worked times the number of people employed times their average hourly wages, and what you see is we're growing now only at 2%. So we're not quite back to the trend we were prior to COVID in terms of the aggregate labor income. So if the Fed's looking at the entire job market and how that's going to affect the economy and retail sales going forward, this is certainly a step in the right direction, but it's not quite done. So I agree with what Jeff Rosenberg said earlier. I think this maybe helps pull taper forward a little bit. So I do think that we might get taper by the end of the year. Maybe probably not announced in September, but November for an immediate taper. And then from there, the question is, how fast do we then grow beyond that? And that will ultimately determine when the Fed actually starts.
And for non-pros out there, Catherine Judge up at CIBC in Toronto frames the taper in the Q1-ish of 2022. I don't want to put words in her mouth, but I think that's where CIBC is. Ira, what's the differential between a taper in November, you pick the month, or a taper in April of next year? What's the so what of that?
Well, so the so what is twofold. One is the Federal Reserve is still buying a large share of the market right at a time when the Treasury Department is going to actually be decreasing the amount of bonds it's issuing. So it looks like in November, the Treasury Department is going to start issuing less 2 years, less 10-year notes. So as they do that, you wind up with a supply-demand dynamic shifting, where if the Fed was still purchasing a lot of securities, you'd probably get even lower yields than we have now, because the Treasury is reducing supply, and there's still a lot of demand for Treasury securities. Now, and what does that mean? Well, I think in large part it means that it's still going to be hard for the market to have a taper tantrum-like event where we get a 100 basis point move in 2 months. But that doesn't mean we can't move substantially, because when you look at a lot of our models, like we made most of our models show around 1.5% as fair value right now for 10-year Treasury yields. So we still have another 25-ish basis points to go before we kind of get to fair value. And then, typically you overshoot a little bit. So I think it's most likely that by the end of the year, we'll get back into the range where we were kind of the February to May time period, where we were 150 plus or minus a few basis points, and then the market will reevaluate what really is the path of the Fed and the path of the economy.
Ira, when I look at the bond market action, there's more action in the long end than there is in the short end in terms of yield curve steepening, higher yields at the long end, not as much action on the front end. Basically, the indication being people don't expect the Fed to pull forward their rate hiking cycle that much. Perhaps the taper, yes, but not necessarily rate hikes. Do you think that that's accurate? Do you think that that's actually how it's going to play out?
Well, I think that is exactly right, Lisa. I think that's exactly what the market's telling us right now, is that, hey, the Fed will be buying less of the market. They'll be taking out less interest rate risk. And because of that, the long end winds up being a little bit more susceptible to sell-offs. Meanwhile, I'm looking at the front end. I'm looking at Eurodollar futures, looking at SOFR futures, and all of those, like you mentioned, a little bit at the margin increasing the risk of a 2023 hike, but really not very much. It's more that they're going to go later, but maybe go faster, and that's actually being priced into the Eurodollar market right now.
Faster in a measured Greenspanian way, or do we get, let's clear the markets in November and on into 22 with some real significant rate moves?
Well, I don't think for the Federal Reserve that my personal opinion is they're not going to hike before 2023. I think that there's always some bump in the road that ends up, kind of letting you be a little bit more cautious. And we certainly, even if they start in November, they're not going to be done tapering until June or September, depending on how fast they go. So in an environment like that, the earliest they're going to go is late 22, which is fine. A lot of members, James Bullard and others have talked about late 22 being when they expect to hike. But I think that's a little bit too optimistic, because at some point we're going to get some hiccup, and it might not be pandemic related. It may just be supply chains or another trade war, something like that causes the Fed to just pause for a couple of quarters, and then finally they start hiking in 23.
Ira Jersey, thank you so much. With Bloomberg Intelligence Chief U.S. Rate Strategist. I do want to point out, folks, the red and green on the screen is blinky. There's a lot more energy 26 minutes on from this jobs report than I would usually see as well. Lisa, an incredibly important vector and chart from Kathy Jones over at Schwab, where she just takes the good news of this jobs report and says, when do we get back to Valentine's Day? And the answer is 2 years out. Pre-pandemic gets us back to the good news about February of next year.
And this is the key issue. These are fantastic numbers. We need more of them to get back to where we were pre-pandemic. And really, the markets might be a little soggy in certain corners, whether it's a bond market sell-off or whether it's the NASDAQ dipping low ahead of the open here. But this is great news that people are getting back into the market. Participation is increasing, the hourly wage increasing. All of this is positive for the worker, but there needs to be more. And people keep talking about the millions of people still unemployed, still out of work, which is the reason why economist after investor come on this show and say that accommodation is still necessary. I'm not taking a stand, but that's the argument on the other side.
Andrew Hunter at Capital Economics notes, quote, acceleration. Lisa, can we define substantial further progress as this moment?
No. I mean, we could try, but I don't think that we're in the seat. I think that Fed Chair Jay Powell will say that this is further progress, and it'll be interesting to see when he starts saying substantial. And probably, I mean, all of the Fed officials who've come out, they've said it's not going to be just one report.
How about this statistic removed? Oil bounces back $1. That's important. Lisa, gold down $29, decisively below 1,800 an ounce. I'm sorry, markets are moving to this combined 1.8 million jobs over 6 60 days.
And the fact that you're combining the two is important. The idea that we had that upward revision to last month so that it looked much worse than it actually was. We actually are having a succession of positive jobs reports, and how much just changes the dialogue is important. I also think what Jill Carey Hall of Bank of America Securities said was interesting as well, which is that a lot of people are looking to consumer discretionary companies and how much they might have to pay their employees more as these wages increase. I mean, we're seeing this across the board, company after company offering all sorts of benefits to bring people online and having to broaden out how much they increase pay throughout their staff.
Well, we're going to keep this dialogue going. This is truly, within this natural disaster we've all faced, an historic day. Coming up, I really want to focus on a discussion with Mr. Farrow, Dr. El-Arian, Professor El-Arian of Queens College, Cambridge, with that important Washington Post essay. Who does Mohammed El-Arian listen to? Jerome Schneider will join us on Bloomberg Radio in moments. He is outstanding on the short-term dynamics of the bond market. Stay with us. This is Bloomberg. Good morning.
It is a tremendous payrolls report in America. From New York City for our audience worldwide, good morning, good morning. 30 minutes away from the opening bell. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
From New York, we begin with the big issue, some rocket fuel for the Fed debate.
All eyes are on the Fed.
As it relates to the sort of the fate of policy
In terms of tapering,
it's going to be entirely about what happens with these payroll reports.
We're back in an environment where investors are scared of the Fed's shadow.
Employment getting back to full capacity is going to be an important marker for the Fed to start to taper.
That's the missing piece of the puzzle.
Markets want to see a continued dovish Fed.
Positive data actually could create a little bit of a policy risk, going forward.
We still need to look further ahead.
September and Q4 is a time when labor supply might begin to be unlocked.
The September-October report,
as we get closer to December,
what they need to see is labor force participation picking up.
At that point, I think the Fed will start to taper.
They are going to prefer to remain patient rather than putting on the brakes too soon.
It is a fantastic jobs report, 943,000. The expectation was 870. Let's bring in a team. BlackRock's Rick Reeder and Mohammed El-Arian of Queens College, Cambridge. Gents, your initial reaction. Mohammed, to you first.
A very strong report and a very important one for the economy. Strong job creation, big drop in unemployment rate, high employment to population, higher hours worked, higher wages, and favorable revisions. John, this is an across-the-board favorable report for the economy. It's a really good thing.
Rick Reeder, your take?
Everything Mohammed says right. The thing I then there's some people talking about this is it's a big report, it's historic, et cetera. Actually, if you go back the last 6 months, you look at the non-seasonally adjusted data. We talked about this last month on your show. It's been 1 million jobs almost every month for the last 6 months. This is a critical node for the Fed. It's not just, we just got one big report. It's a month after month. As Mohammed said, they revised up, actually, the non-seasonally adjusted June number. It was 1.5 million jobs. So anyway, point being, this employment growth, it's not a question of are there enough jobs available. It's do we have enough people to fit those jobs, and meaning the momentum of hiring will continue and be durable.
Got to talk about wages too, guys. Mohammed, 4% year on year. Bob Sinch wrote in on the Bloomberg terminal. He said, clearly a sign of higher wages to bring workers back and the Fed falling behind the curve. Would that be your conclusion too, Mohammed?
Yes, because what happens, John, is once you offer higher wages to bring people in, especially at the lower level, you have to offer higher wages across the board. Why? Because people will move. People are mobile. So you get the job churning process. So yes, this is going to embed itself, and the Fed risks falling behind the curve and having wage push inflation, cost push inflation, and demand pull inflation, which is going to be very hard to counter down the road.
Rick, do you agree?
I couldn't agree more. I think people focus on the data or the way the economy reacted in the 80s, and you're in a dynamic now where there is the momentum of hiring will continue. It has the Fed putting $120 billion a month in the system has absolutely no influence. In fact, the influence could be denigrating at this point because you create this overheating. And we think about how companies think about their business. It's a return on invested capital versus their weighted average cost of capital, and their expense base is going to be. If your expense base is going to be more difficult, if your margins compress, you're going to spend less in terms of. You can do less in terms of hiring. So we're at a point today. We've hit, as Vice Chair Clyde has said, the inflation target. We've clearly eclipsed the inflation target, and we are on a road to maximum employment that is not being aided by emergency conditions stimulus that's being put in the form of 120 billion a month of quantitative easing. The risk is to the other side.
Jobs report is rock solid. Yields are higher by 6 basis points on 10s to 128. You see the split in the equity market. The Russell advancing 0.75%. The Nasdaq, the tech-heavy Nasdaq, down by 0.5%. Let's bring in Michael McKee for a little bit more. Mike, rock solid.
Rock solid across the board, because not only did we get 943,000 jobs restored in the month of July, the months of May and June were revised higher, June to 938,000. So we've got 1.8 million jobs today that we didn't think we had a month ago. The unemployment rate falls to 5.4%, and this was for good reason, because 1 million people got jobs in the household survey, and more than 700,000 reported they were no longer unemployed. So that works out well. The only thing that didn't go up big was the participation rate, but it did tick up to 61.7%. And the employment to population ratio, this is something the Fed is watching because they want to know how many people are coming back into the labor force. 58.4%, a big jump from 58%. U6 unemployment, 9.2% from 9.8%. And of course, the Fed's looking at minority unemployment as one of its inclusive indicators for tapering. 8.2%, a drop of a full percentage point for blacks, and 6.6%, a drop of almost a full percentage point for Hispanics. In terms of job creation, services was the big winner, and no surprise there, 659,000 jobs created. Manufacturing, 27,000. Construction ends a string of 3 months of job losses with 11,000 gained. And restaurant and bars, 253,000. Now, this is what we expected, and it is why we find the earnings increase a little bit puzzling, because those are lower paid jobs, and yet earnings go up a lot. I'm not going to disagree with my friend Mohammed, but I'm going to say it's too early for the Fed to make the decision that it's behind the curve, because yes, companies are paying a lot more to get people to come back to work, but do they have to keep paying more? Do they have to offer next year another round of raises? That's going to be the question for the Federal Reserve.
Mike, you went there, so let's go there to Mohammed. Mohammed, your response to Michael McKee.
I say, Mike, just wait and see what happens. I'm listening very carefully to what companies are telling us. They expect to pay more going forward. I go back to what Rick said, which was really important, is what are the benefits of continuing with this pedal to the metal approach on monetary policy? What are the benefits? People can't figure that out, but the risks and costs are mounting. It is about fueling a red-hot housing market. Why are we buying 40 billion of mortgages each month? It's about making inequality worse. It's about risking inflation. If you look at type 1 and type 2 error, type 1 is you move too slowly, type 2 is you move too early, right? I think it's very clear where the balance of risk has shifted.
Sounds like you both agree with Senator Manchin. Rick and Mohammed, this is what Senator Manchin had to say to Chairman Powell in a letter that he published yesterday afternoon. I am deeply concerned that the continuing stimulus put forth by the Fed and proposal for additional fiscal stimulus will lead to our economy overheating and to unavoidable inflation taxes that hardworking Americans cannot afford. Do you think to a degree here, Rick, this could overwhelm the goals of this administration and this Federal Reserve, the data we're starting to see?
So I think the inflation, the overheating is a risk. I mean, I think, and he mentioned, or others have mentioned, the 40 billion a month of mortgages in an overheating housing market. I mean, by the way, not only is it making housing less affordable, but it's creating a dynamic that is obviously, I think, denigrating to that market and creating concern about what happens going forward. The other point that I think is people don't talk about enough. there is the amount of safe assets that are being crowded out by the Fed. You create this trickle-down effect that once you crowd out and you create real rates at too low a level, then treasuries, people say, gosh, treasuries move to levels that don't make sense. Agency mortgages move to levels that don't make sense. People take more risk. You create this dynamic that results in what could be a vicious loop. And we've seen this play out. I mean, we're watching some of this financing take place at the wrong levels. And you create a risk that I think as people underestimate the potential tail risk from excessive investment at the wrong price. And by the way, we're not at a place today that if you just start to back down, the system will be fine, and the growth will continue to be extremely strong. I'm blown away when I look at companies' balance sheets, the capex spend, the R&D spend.
Yeah.
The economy's going to be fine. We just don't want to overdo it.
This is a point that Mohammed made. Mohammed, I want to return to that point that you've made repeatedly over the last several weeks. Don't listen to the policymakers. Listen to the C-suite in corporate America. Why is that so important?
Because if you just look at your macro models, they're not capturing structural change. And there's a lot of structural change going on in the economy. So listen to those driving. I completely agree with Rick. Business investment is going up. You have strong household demand, you have strong corporate demand, you have strong government demand. Do you really want to put the Fed on top of that? He spoke about a really important thing, which is resource misallocation, because the price signaling mechanism is distorted. That's not a good thing. We have excessive and I would say irresponsible risk-taking in some parts of the economy. That's not a good thing. We have a housing market that's pricing out Americans. That's not a good thing. So when I look at that, this is time for the Fed to start tapering. If it doesn't, we don't only risk the durable, inclusive, sustainable recovery, we also risk the Biden administration's agenda. That you already have people say, cut on fiscal. The economy is too hot. Actually, no, keep the fiscal, because that's investing in physical and hopefully human infrastructure.
That's your argument in the Washington Post this morning, Mohammed. Just published the title, The Fed's Ultra-Loose Monetary Policy Could Hurt Both the Economy and Biden's Agenda. Mohammed, Bill Dudley has made the point that when they do go, because they're waiting too long, they'll have to go much more quickly and rates will have to go higher. You've had a little bit of a difference with Mr. Dudley over that, the former New York Fed president. Is that gap sort of tightening for you and him? That maybe that's the scenario you could see playing out?
Look, I have tremendous respect for Bill. And when Bill says, look, they're going to slam on the brakes in a really big way, I pay attention to what Bill is saying. He was in the New York Fed. He understands how these dynamics are working. So, I pay attention to what he's saying. The reason why I don't think we get there as fast as he said we may get there is because it's not just a question of what they should do. It's a question of what they're willing to do. And this Fed is very, very concerned about another disruption to the markets. They remember 2013. They remember the fourth quarter of 2018. So they're going to go slow, even though they should go a little bit faster than they have been so far.
There is one key question that many people are asking, whether the developments of the last month or so will derail everything we're talking about. Wall Street is grappling with the rising COVID infections. We've seen company after company delay the return to office. BlackRock, Wells Fargo, now the latest. I want to turn to Abby for a little bit more on that. Hey, Abby.
Hey there, John. Well, for sure, the Delta variant is introducing a new risk to the macro picture as COVID is creeping back higher here in the U.S. Big companies responding in a big way. Just this morning, United Airlines, the first major U.S. airline to require its workers to become vaccinated. As you mentioned, BlackRock, Wells Fargo just yesterday, pushing the return to work to October, really telling us that finance is rethinking that return to the office. And Amazon employees won't need to return to the office at all this year. Now, relative to COVID itself, the COVID curve is creeping higher swiftly over the last 7 days, on average 100,000 cases. Now, that's nowhere close to the 250,000 cases at the peak in January, but take a look at the trajectory. It is swiftly rising, and this is what has businesses and folks around the country worried. Now, relative to the distribution of cases, it is uneven. The South is getting hit especially hard, led by Louisiana, Arkansas, Mississippi, Florida, and Alabama. The 7-day case pop for those states much higher than overall, but it's very clear that this Delta variant really throwing in new risks to the overall environment, John.
Abby, thank you. Thank you very much. Rick Reeder, your thoughts on this, these developments that have really started to build over the last few weeks, what they could mean for that return to office, what they could mean for the delay of a full service sector recovery?
Yeah, I mean, that is the fly in the ointment in terms of the economy. By the way, not just domestically. I mean, we're following the data in Japan. We're following data in parts of Europe where it's a bit uneven, but there's some pretty enthusiastic or optimistic things in parts of the UK. Is actually some of the data we're looking at today. It's better in the UK, but it is the fly in the ointment. I mean, we have to. Many companies are going to make, as I said, are going to make the determination that risk reward, it's worth postponing a bit. So it could take a little bit of the froth off the economy. I have to say, I mean, we're looking at a bunch of companies today, and part of why I actually think, while real rates are too low and the risk-free rate's too low, the equity market, there's still some real value. There are a lot of companies that actually, in this environment that we saw last year, actually operate pretty well, have moved to an online, moved to a more virtual. So we're looking for companies that are more durable through that, because it definitely is no doubt you can't write that off as a risk.
Where are you finding them, Rick? Where are you finding those companies?
Yeah, Jonathan, I'm actually blown away. I mean, in a world where valuations have moved up, I went through a couple yesterday that are actually retailers. Those people have said, gosh, the reopening is going to be a bit slower. And I'm looking at some of these retailers and how much they've repriced. Some of them who actually transitioned to an online framework in terms of their business that are still throw off last year 20, 25%, 30% ROE. I was looking at one yesterday, it was 45% ROE through 2020 and their last 12 months. And so I think those are pretty interesting. By the way, they traded earnings yields of 7-8%. So you think about earnings yields, even if you haircut them a bit, at 7-8% versus real rates in the treasury market at negative 1%. So it's some of the industrials, some of the consumers actually pretty interesting today. I still like tech and healthcare, and those are the places where we're tending to focus. But the valuations are actually, when you actually go underneath the surface, you look at that cash on hand they're sitting on, the ROE they're generating, the free cash flow. These multiples are really not bad. So, it's a weird world because the hedges and how you think about a balanced portfolio have to be a bit different. Why different? We talked about in your show, you hold a bit more cash. It's because equity is a much better trade than it is owning some of these mispriced assets in the rates markets.
It's always really interesting hearing you both. The data's fantastic. You're both uncomfortable with the trajectory maybe for policy, the path of policy from here on out. Then, Mohammed, when I ask about the markets, you're both comfortable with where the market is. Mohammed, do you share that view?
So I share the view that there are individual names that are attractive. Timing is a little bit tricky because the overall market has been impacted by ample and predictable liquidity. And to the extent there's a question mark on ample and predictable, then you've also got to deal with this common factor, which is the liquidity factor. John, if I can stress something is different about this Delta variant. It's not just that it's the infection rate. There's a silver lining that I think is missed, which is it's accelerating our ability to live with COVID. It's accelerating companies having to deal with the issue. It's not going to disappear tomorrow. We're going to have to manage through this. Households are having to make difficult decisions. So while it is a short-term headwind, it may actually make the longer term better because we've got to learn to live with COVID. COVID is not going to disappear completely. We're going to have to manage through this for quite a while.
Mohammed, it's such a good point. Mohammed sticking with us alongside Rick Reader. Coming up, an upside surprise on a payrolls report and the President of the United States addressing these numbers in less than 90 minutes' time. Jason Furman, just one line from Jason. I've yet to find a blemish in this jobs report. I've never seen before such a wonderful set of economic data. From New York, this is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Does change the game in terms of asset selection. We've been underinvested in the U.S. for over a decade. We know that the government-led infrastructure tends to beget private sector investment as well in our roadways, in our waterways. You'll likely see a mini infrastructure boom as we come into 2022 and beyond.
Erin Brown of PIMCO on the pass forward down in Washington, D.C. Down in Washington, D.C. in about 90 minutes' time, call it an hour and 10 minutes, we'll hear from the President of the United States. Down in Washington, our Washington correspondent, Bloomberg's Anne-Marie Hordern. Morning, Anne-Marie.
Good morning, John. Yeah, that's right. We wait to see what the president says on the heels of this very positive jobs report. Also, a pretty healthy revision when you look at the June numbers as well. And, John, what politicians do is they take data and they use it to advance their economic agenda, which is the president is going to do. And he's likely going to say, probably similar to what we hear Mohamed El-Erian saying to you this morning, as well as in his Washington Post opinion, is that more still needs to be done. Even though this is a very healthy and good jobs report, and it's moving in the right direction. He's going to say that his fiscal agenda and the bipartisan as well as the soft infrastructure that the Democrats want to get done still needs to get done to shape this economy coming out of the pandemic.
Anne-Marie, thank you. Let's turn to Rick Reeder and Mohamed El-Erian, still with us on this debate down in Washington. Mohamed, we've read through the piece from the Washington Post from you this morning. I want to talk about this bond market. This bond market does not look overwhelmed. Yields are higher today by 5 or 6 basis points, but it's a yield of 128. Mohamed, 128 on 10s. What are we doing down here?
What were we doing at 112 a couple of days ago? I think Rick will answer that question much better than I can. I can only tell you that it's not overwhelmed right now because it thinks that it correctly thinks that the Fed will want more than just one strong report or more than just 2 strong reports. That's why it's not overwhelmed.
This is what Governor Waller said earlier in the week. I think you could be ready to do an announcement by September. That depends on what the next 2 jobs reports do. If they come in as strong as the last one, then I think you have made the progress you need. Now, Rick, let's work through this. If we do get a repeat of this on September 3rd, another number, another report that looks as stellar as the one we've seen this morning, and we start to say, okay, September 22nd, nailed on. Tapering is going to be announced. I have no idea when it starts, but it's going to happen this year. Is that bullish or bearish for this Treasury market, Rick?
So, well, I'll tell you, it's unequivocally bullish for the equity market. And when people say, my God, the Fed tapers, and they think about points in time. By the way, when the Fed tapered at 13, the equity market paused for a few days, and then it finished the year quite strong. So there's no question in my mind what it means for the equity market. People will use prior when the Fed's tightening. The Fed's just moving off of emergency conditions. So that, to me, is unambiguous. The rates market, should rightly back up. I mean, so when you think about why are we at these levels today, you've had uneconomic buyers of significant size that have been buying. You've had obviously the Fed buying too much per month. You've had the TGA pay down. The Treasury General Account has paid down, stuffs the system with immense amounts of liquidity, over $1 trillion of liquidity that's come in, got into the banking system. That's gotten recirculated. And Asia, including bank deposits in China, rate differentials in Japan, pension funds, insurance companies. So you've had this dynamic. Nobody thinks these rates make any sense. Nobody thinks real rates in an economy that is evidenced by today is operating level it's at. Nobody believes these real rates are normalized or anything close to normal equilibrium. But there's an uneconomic, largely because the liquidity in the system is too darn large, that is creating this dynamic that is forcing people into this rates market. So naturally, what I think will happen is we'll start to migrate higher in yields. The Treasury's general account pay down is over. That was huge. And if the Fed tapers, you take some of that froth off the liquidity dynamic, and that'll cause rates to back up a bit. But listen, we're going to be in a low rate environment for a long time, and but I think we can back off some of these. Some of these would have been some insane levels in terms of where real rates are.
Rick, let's explore the idea that maybe this economy can't tolerate interest rates too much higher than where they are right now. Might sound crazy at 130 on 10s and a Federal Reserve basically a 0. But Rick, have you given that some thought? that maybe our tolerance levels for higher interest rates from here have greatly diminished over the last 12, 18 months?
John, that's definitely right. I mean, we are, and by the way, I think the system can absorb more debt. I think the fiscal initiative is exactly the right thing. You're going to get an infrastructure. You're going to create what is real durable growth to an economy. And so, but you put on debt alongside of that, but the economy can withstand it. We're in a very different demographic we've been in historically. The system can absorb that. However, you can't have a shocked rise in interest rates because all of a sudden, when you look at CBO estimates to what happens to the interest coverage on the economy, it becomes really difficult if rates are shocked higher by a couple of percent. So when you look at traditional metrics, how I've looked at companies for years or structures for years or real estate for years, the interest coverage in the economy today is quite reasonable to deal with. The asset coverage is quite reasonable to deal with. But if you shock rates significantly higher, it's a problem. So I think we're going to be a low rate environment. I think the Fed is right in keeping them lower and deserve their due for that. It's just you don't need to sit at a 130 10-year and at where we're at today, or 112 where we were. A bit higher we can withstand. But you're right, we can't withstand a couple of percent higher. That would be real difficult.
Mohammed, you've made the same argument. This system, what can it tolerate? The kind of rate of inflation that it can tolerate, the higher interest rates it can tolerate. Can you explore that with us now?
Yes, I mean, Rick is right. The system has been wired and conditioned by the Fed to operate at very low interest rates. So if you shock it with very high interest rates, it's going to take time to adjust. Never underestimate the role played, and I use Rick's word, he called it an uneconomic buyer, I call it a non-commercial buyer. The Fed is a very large non-commercial buyer in markets, and non-commercial buyers distort everybody else's decision-making. If you don't believe me, go play a board game and play to your own rules, not to the rules of the board game. You will change everybody else's behavior on the board, because that's what happens if the biggest market price setter is non-commercial, is uneconomic. It distorts everybody, and therefore it distorts the system. So look, we've got to adjust at some point to more normal rates. It's not going to be easy, but keeping it at artificially low rates makes that adjustment process, which is necessary, even more difficult.
You're a man that I do not want to play Monopoly with. Mohammed, it's good to catch up. As always, Mohammed Al-Erin and Rick Reader of BlackRock. Gents, I appreciate it. What a morning for it. A morning where we have a monster upside surprise on the payrolls report, and the debate continues on this program with PGIM's Michael Collins and iCapital's Anastasia Amoroso. From New York City this morning, good morning. Your opening bell coming up next. This is Bloomberg.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
24 seconds away from the opening bell in New York City this Friday morning. Good morning. A tremendous jobs report, a word that so many of you have used this morning. 943, we were looking for 870. Futures are positive on the S&P by about 4 points. The outperformance is on the Russell. The small caps up by 0.75%. The underperformance on the NASDAQ, we're down 0.4. That's the opening bell. Switch up the board and get to the bond market. Your 10-year yield looks like this morning. Yields are higher by 6 basis points to 128.18. 10s are softer, yields are higher, the curve is steeper. In the FX market, the dollar's stronger, euro dollar negative 0.4% to 117.83. And commodities, crude with a little tick higher. We had a little look at $70 a barrel earlier, 69.61 right now, up by 0.75%. That's the cross-asset price action. Let's get you some movers at the market desk. Here's Katie Greinfeld.
Well, John, the big banks are some of your early winners after that very strong jobs report. JP Morgan, Citi, and Wells Fargo all gaining over 1%, taking their cue from a pop higher in rates. 10-year Treasury yields broke above 128 after the release, with job and wage gains accelerating in July. Moving on to earnings, Zillow blew past estimates thanks to that red-hot housing market. The company also lifted third-quarter revenue guidance. That's lifting shares. AIG also popping after beating for the 5th straight quarter. And CEO Peter Zaffino said the company has incredible momentum heading into the second half, John.
Katie, thank you. Let's bring in our guests, shall we? Anastasia Amoroso of iCapital Network and Michael Collins of PGIM Fixed Income joins us right now. Anastasia, I want to turn to you. Your reaction from the jobs report that dropped 60 minutes ago.
Well, good morning, Jonathan. It was a very encouraging, as you say, tremendous jobs report. And I think it's going to go a long way in encouraging the Fed as well. What I found to be one of the most optimistic things, positive things about this is the fact that the leisure and hospitality jobs, those were amongst the top gainers in this jobs report. So the reality is if the Fed wants to move closer to full employment, it's this particular sector that needs to see the most healing. In the prior jobs report, we saw the sector have a 10% or over unemployment rate, and the fact that this now dropped to 9% is very significant. Now, the other thing I would mention, leisure and hospitality and wholesale and retail trade account for over a quarter of all the individuals that are unemployed there. So the fact that we're making progress on this particular sector is very important. Now, I'll put one caveat in there, is that this Payrolls report happened before the surge in the Delta variant cases. So the next 30 days is really going to be critical to see how businesses adjust, how consumers remain more cautious or not. So the next 30 days are really going to be critical. Very encouraging, very consequential report, but I think the next Payrolls report is going to be the decision-making report for the Fed.
Mike Collins, two really important points here. The first one we all agree on, tremendous, solid report. The second comment, what are the changes we've seen in the last couple of weeks do to this supply-side response in the coming weeks? And I'm thinking about the likes of BlackRock, Wells Fargo, others who have delayed that return to work, what that would mean for the economy more broadly.
Yeah, that's a really great point that Anastasia brings up, right? This is a great report, no doubt about it, but if you want to poke three holes in it, or at least look for reasons to continue to be patient and look for the data coming in over the next few months, right? It was really before the big spike in COVID cases that seem to be pretty consistent right now and going up steadily across the country, across the world. Two, you did have this weird seasonal effect on the teachers, right? Huge growth in government employees and education. We have to figure that one out. And the total amount of people coming back to the labor force didn't really grow that much, which is why you saw the unemployment rate drop so much. So again, I think the markets, I think the Fed are going to be looking at the number in September, the number in October, and kind of see what trend we're looking at.
Well, that's the question I was going to ask, Mike, whether they need to wait for the number in October looking back at September, or whether the number on September 3rd looking back at August gets it done on September 22nd when they next meet. A lot of dates there, I know, I apologize. The reason I ask this is because Governor Waller came out this week and basically said, if we get 1 and 2, this one and the next one, we're good to go in September. My words, not his. I'm paraphrasing, Mike, but that was basically the argument. Do you think we can just get it done, signed, sealed, delivered September 3rd and say September 22nd, an announcement is coming?
Yeah, I mean, if we get another really strong number on the September jobs report, Jonathan, that'll really be 3 months in a row where we've had, these close to a million jobs numbers a month. I mean, that'll get us those 8 million people back, by the middle of next year pretty quickly. So I do think September's in play for announcing the tapering. I mean, somewhere between September and December, right? They're going to make an announcement. We all know that. I think we're, kind of slicing it pretty thin here to try to figure out exactly when, but they're going to start the taper either late this year or by January at the latest would be my guess. And they're probably going to do 15 billion a month, 10 billion of treasuries, 5 billion of mortgages. They're going to be done tapering between June and September of next year. Yep. And I think that's priced in and everybody recognizes that.
This is the sequence of things when we experience these kind of questions. We start with the data, and then we say, okay, what does that mean for the Federal Reserve? And then we say, okay, what does that mean for the market? Anastasia, if you just say, look at the data, okay, the Federal Reserve's going to have to taper. With these kind of numbers, is this a market that you'd want to sell into? If we can continue delivering really strong, robust growth, and we get a supply-side response in the economy as well, and this feeds into a better outlook for 22 as well?
No, Jonathan, I don't think this is the market you want to sell. I think you want to continue to be in the equity markets. But I will discern amid some of the sectors that I would expect to perform under this environment versus maybe lag a little bit. First of all, going back to the rate side, obviously, as we pull forward the Fed taper, there's upside to be had to interest rates. But I would say there's two other meaningful factors that should drive rates, and it's where growth is and what are the revisions to that growth. And one of the things that I'm seeing right now is that the consensus for global GDP is coming down just a notch. The earnings revisions, the best of the earnings revisions, are now behind us, and so analysts are starting to not revise those earnings quite as much. So if we don't have this further growth momentum in the broader economy against the Delta variant, I think you're not actually going to see materially upside to rates. The reason I bring that up is because you might say, well, rates are a little bit higher, so go into cyclicals. But what cyclicals? You've got global PMIs that seem like they're peaking. So maybe you don't want to go to industrial materials and so forth. The trade that I think is very compelling around these current levels is the travel reopening trade. If you look at the hotels and airlines and cruise lines, they've actually pulled back since the highs that they've hit in mid-March. So I think what we're starting to see right now, some of the peak Delta variant fears are starting to be priced into those stocks.
Interesting.
They're down 18% or so from mid-March. So I would actually use this opportunity in the next few weeks to reload on this travel reopening trade. I think that's the one you want to be on looking through to 2022.
This reminds me of a line that Mohammed used about 20 minutes ago, Anastasia, that maybe would reinforce that argument. The silver lining of the Delta variant is accelerating our ability to adjust to live with the virus. Mike, do you see a similar opportunity on the credit side?
Yeah, the credit market, John, is rock solid. Credit fundamentals are improving at about as fast of a clip as I've ever seen in my career, right? You're seeing leverage numbers come down, EBITDA numbers really surge. I mean, companies have done a remarkable job adjusting to this new world, whether they're in those cyclical COVID-sensitive sectors or not. But as Anastasia said, earnings growth is really heady now. It's going to be a lot lower next year. We are seeing some cases where profit margins are starting to be challenged. But generally, this is a really good market to be in the credit sectors. It's about valuations, though, right? And valuations, arguably, in parts of the market look pretty stretched. So we have taken down overall levels of corporate credit risk. And remember, in addition to the cyclical factors, there is event risk. These companies are, now that they're more optimistic, they're getting more aggressive and buying back stock and buying other companies. And now you have this new regulatory risk to the system that the Biden administration seems to be embracing, which also puts some pressure. So I think it is time to maintain a little dry powder on the credit side.
All-time highs on the S&P 500, up 0.2%. Outperformance on the small caps, the Russell up 0.6. Underperformance on the NASDAQ, we're down 1/10% there. Looking through that, here's Abby.
Well, John, there is a very simple way to describe describe the reaction to this blowout jobs report. Reflation up, tech down. It's that simple. If we take a look at the S&P 500, an all-time high. The NASDAQ, not so much. It is down. But take a look at that Russell 2000 that you've been talking about. Those small caps really responding well. This has everything to do with yields backing up. Now up 16 basis points on the 10-year yield from the Wednesday low, as investors are no longer looking for those haven bonds. Pressuring big tech, as you can see, Apple, Amazon, Alphabet, all down. Of course, valuation concerns come back into play for these growth stocks. But what sector is doing really well? Naturally, the banks. The KBW Bank Index up more than 2%, up for a second day in a row, its best day in about 3 weeks. Again, having everything to do with yields higher on the day, John.
Abby, thank you. Let's go to that bond market. Yields are higher. The curve is steeper. We're up 5 basis points on 10s to 127. Anastasia, how important is that call on the bond market? Does it underpin all of your calls more broadly, or are you looking at things a lot more nuanced?
I think the bond market call is definitely very important, and we have to discern from the bond market what kind of growth expectations are being priced in. So one of the reasons I said that there's maybe peak fear that's being priced into some of the travel reopening stocks, because we can extrapolate the growth rate that's being priced into the 10-year treasury, and it has fallen significantly. One might argue that it had fallen too much. So I think it's a very important part of the call on the reopening trade. But I want to come back to something Abby just said about the tech side of this. I would actually think of doing a barbell approach to the portfolio right now. I like the reopening trade, but the reality is the cyclical momentum beyond this, travel rebound trade is going to slow next year, and investors are going to be right back to square one. Where can I find growth over and above the S&P, which is going to be growing 10% or so next year? And the answer to that lies once again in some of the longer-term secular trends, whether it's software, whether it's semiconductors, whether it's fintech. Those are the sectors that I think once again are going to gain investor attention. And the cloud, so some of those big tech names, I think this is a buying opportunity for those as well.
Backing up that call, Mike Collins, let's get to the Mike Collins call that maybe probably you think we've seen the peak in 10-year yields already this year at 174. You think that might be it?
Yeah, for sure. I think everybody recognizes that that was a pretty big overshoot on 10 years, right? That was pricing in a funds rate getting up to 2.5% and basically staying there forever. We think fair value on the 10 years probably between 1 and 1.5, and we're right in the middle of that now. We have cut duration in our portfolios, but I would love to see rates kind of go back toward the high end of that fair value range, that 1.5. That's a good thing for everybody, right? Remember, the pain trade in the world is lower rates, not higher rates. We should all be embracing higher rates, and we would definitely, look to add duration and get more aggressive if we retest that higher end of the range.
This jobs report is a good thing, better than good. 943, the number, 870, the estimate, and some really nice positive revisions as well. Coming up, Anastasia Amoroso, Michael Collins sticking with us. President Biden gearing up to deliver remarks on the U.S. payrolls report. More on that conversation still ahead. From New York, this is Bloomberg.
E3 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Had an exceptional Q2. It's time.
The narrative of the day is strong earnings.
Bloomberg has the numbers.
We have about $12 trillion worth of market cap right here.
Find out who's winning.
Tesla beating across the board.
And who's losing.
That's actually pretty rare for Amazon. They typically don't miss on that scale.
And the voices to give you the important news.
Samsung reported another stellar quarter of earnings.
We are very clearly looking with confidence about what's next.
Bloomberg Television, your home for earnings season.
Had a lot of kind of negative surprises, focused really on the Delta variant. It's important to remember that this payroll report is really pre the CDC mask wearing change in guidance. It doesn't really incorporate some of those more recent changes. Let's be clear, this is a very strong report across all metrics. There's very little that you could point to here that's disappointing. And if we add to that, some signs of a broadening out from that inflation that we're seeing in the wages here, this could be that regime shift in terms of the direction that we've had on interest rates.
Jeff Rosenberg there of BlackRock, following a really nice upside surprise on a payrolls report in the United States of America. The number 943,000, the estimate 870. It's just solid across the board. You push that through the bond market, this is what it looks like. Yields are higher on 10s by about 6 basis points to 128, on 30s to 192.57. We advance there 6 or 7 basis points. If you switch up the board and get to the equity market, you take the bond market move, you push that through stocks, it means small caps are positive, and the NASDAQ is negative by 1/3 of 1%, the Russell up by about 1/2 of 1%. I want to bring in Michael McKee for more on this number. Mike, this line from Jeff Rosenberg of BlackRock I think is so important. The CDC mask-wearing change in guidance, it does not incorporate more recent changes. That's what he was talking about when he referenced this jobs report. It's important to remember this payrolls report does not date these numbers in terms of just getting these restrictions, Mike. We haven't seen what these restrictions mean for these numbers.
Yeah, it's going to be interesting because, of course, the jobs report is collected. The data are collected for the establishment survey in the week that includes the 12th of the month, so very early in the month. And we saw Delta come back and become a much bigger story as the month went on. So does it carry over into August? And do we see, next week will be the 12th of the month, do we see people reluctant to go out or people putting hiring on hold because of the Delta variant? We're not going to know that, obviously, until September, but it does become a bit of a concern.
Mike McKee, thank you. Let's head back to Anastasia Amoroso and Michael Collins. Guys, we touched on this. I want to repeat that line from Jeff Rosenberg of BlackRock. I won't screw it up this time. He's talking about the numbers and saying that these numbers don't incorporate the recent changes we've seen in this economy. Anastasia, do we have to brace a little bit more for the incoming data? Inflation next week. We've got the employment report on September 3rd. Do you have to wait for that?
I think the next 30 days of data is going to be really, really critical to watch. I do think that we're going to see some of the knock-on effects from the Delta variant in some of the data. For example, even though the travel and hospitality CEOs this week largely said they have not seen their bookings deterred by the Delta variant, I suspect some of that may show up in the activity in August. It's hard to go and have an indoor vacation in Las Vegas, for example, if you have to wear a mask. So I suspect that's going to show up in a little bit of the data. But looking through that, I do think that we're going to come out on the other side of this, because one of the things that's happening is the vaccination rates are actually starting to pick up. And Mohammed says this, that this is accelerating how we're learning to live with the virus. The reality is what's different this time is we have a backstop. We have the vaccines that are effective in many more cases in which they're not. So I think we're going to see the vaccination numbers pick up over the coming months. And what's really important, it's not just going to happen in the US, but it's likely to happen globally. So that's why all in 30 days is going to be important. We'll probably see a little bit of slowing activity on the margin, but looking through the fall, I think we'll see the rebound in activity once again. And Jonathan, let me just bring up one more thing on inflation. You mentioned inflation. This is going to be a key metric to watch, just real quick, because parts of Asian economy are experiencing lockdowns. So we could see further delays in semiconductor shipments and, in car manufacturing. So maybe this transitory inflation that's supposed to be short-lived is going to be with us a bit longer.
Let's finish on that. This is what Mohammed had to say first of all. If you missed the conversation earlier, take a listen.
Something is different about this Delta variant. It's not just that it's the infection rate. There's a silver lining that I think is missed, which is it's accelerating our ability to live with COVID. It's accelerating companies having to deal with the issue. It's not going to disappear tomorrow. We're going to have to manage through this. Households are having to make difficult decisions. So while it is a short-term headwind, it may actually make the longer term better, because we've got to learn to live with COVID.
Mike Collins, we've got to learn to live with COVID. That might be true for our experience here in the United States. Can you say the same thing right now, as Anastasia points out, about China?
Yeah, I mean, COVID is here for probably years to come, Jonathan, and it seems like everybody's getting it at this point, right? This new variant is so contagious, and maybe in 6 months from now, we're kind of hitting some of these herd immunity thresholds. But what really matters is the long term, right? And we're all talking about monthly numbers and monthly stats and what the taper is going to be and the Fed. But what really matters to the economy, to what the Fed does, to the level of interest rates, is what is the Fed funds rate going to be on average over the next 10 years? And I think they're going to hike to 1% or 1.5% and get stuck there. And that's how we get to this fair value range on the 10-year. So you really have to focus on the long term and put aside some of these short-term uncertainties.
We're trying. Mike is hard on Payrolls Morning. That's all. Michael Collins, Anastasia Amoroso. Guys, been good to catch up. Thank you. Tremendous jobs report in America. Let's get to the sector price action. With that, here's our stocks editor, Bloomberg's Dave Wilson. Hey, Dave.
Hey, John. You've got 7 of the 11 main industry groups in the S&P 500 higher. It's really the more economically sensitive areas of the market leading the way, whether we're talking about financial companies, raw material producers, energy, industrials. They're at the forefront. We're seeing some weakness in healthcare for the 3rd day in a row. And this time around, it's a disappointing report out of the genetics company Illumina, and also a couple of rating cuts on the COVID vaccine developer Moderna, sort of pressuring that group. In terms of individual stocks, best performer in the index right now is Corteva. This is the former DuPont unit that focuses on seeds and crop chemicals, and it's one of 4 companies in the S&P 500 that are focused on this kind of agricultural supply. And we've seen the group kind of pull back over the last 3 months, peaked in May, down about 17% since then. Today, definitely sort of a turnaround. Corteva really dominates this particular group. It's about half the value. But we're seeing the other stocks rise as well, whether it's the fertilizer makers, Mosaic and CF Industries, or FMC, which is a competitor of Corteva's.
Dave, thank you. Something to look at in this market right now. All-time highs on the S&P 500. Just we advanced almost 0.1% after a tremendous jobs report. Coming up, your trading diary from New York. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Five minutes into the session this Friday morning. Good morning. Tremendous jobs report in the United States of America. 943,000 the number, 870,000 the estimate. This is the equity picture off the back of that, with yields higher at a steeper curve. Equities up 0.1% on the S&P. The Russell advancing about 0.25% off session highs. The Nasdaq down by about 1/3%. It's the division between the two, small cap and big tech, being driven so far by what's happening in the bond market. That's the equity picture. Let's get to the trading diary. The shape of things as follows. What you need to be watching through the day and into next week. In about 35 minutes' time, we're expecting to hear from the President of the United States, President Biden speaking, addressing the Payrolls report, scheduled to be speaking at 10:30 Eastern time. Then a busy week of Fed speak, with President Bostic and Barkin kicking things off on Monday. CPI coming on Wednesday. And finally, US PPI coming up on Thursday. After a blowout jobs report, 943,000 against an estimate of 870K. And every single data point through this, down to unemployment at 5.4%. The kind of numbers we want to see. Will we see more of the same in the next month? From New York City, this was the countdown to the open. This is Bloomberg TV.
has been looking at West Palm. They have been looking at outside of New York for offices. How are you thinking about your footprint as people return to the office and want to work from different places?
Yeah, so it's the new Apollo. You know, I think flexibility is the name of the game. When it comes for us in our business, I think that we really preach the mantra of flexibility. I think we've proven throughout COVID that we could be highly effective. In fact, if you look at the bottom line, I think more effective than we've ever been in our history through a flexible work environment. So as we head back for the fall, we've really preached to all of our businesses to lean in and embrace this flexibility and go where the market goes. You know, we're in a competitive industry. Our portfolio companies are in a very competitive labor environment. And I think businesses that just want to go back to the way things were are missing a huge opportunity to learn from what's gone on over the last 18 months.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water. It's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you'll use the most to send to each other?
So there's a bear which basically we use for indicating a hug.
Yeah, that's our language basically, bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. The massive event usually lasts 3 days, has various ceremonies and celebrations, and involves the entire two families and hundreds of guests. Luckily, there are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned a bachelor's degree from the University of Houston, a juris degree from Rutgers, and practicing law in New Jersey. Warren then went on to become an influential law professor, teaching, lecturing, and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry Citi?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became It's something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you,
millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
And there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people knew was a lie.
This election was not without controversy. And I'm so proud that London has today chosen hope over fear and unity over division.
After taking the mayor's office with a comfortable majority, Khan has brought a business-like efficiency to the role, scrapping expensive vanity projects like the Garden Bridge and the new Routemaster buses, which cost £350,000 each. The former lawyer who used to fight the police in court is now praised for his close relationship with them.
I was talking to a very senior police officer in the Metropolitan Police who said there was a sea change when he went into City Hall, and the police were saying how much they welcomed this because they knew where they stood and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning, who used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the Collateral Murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness.
Once WikiLeaks started exposing secrets of the Democratic Party, Julian Assange became a hero to many on the right. Public opinion kind of flip-flopped.
WikiLeaks.
From the emails, we now know Hillary Clinton's campaign manager makes risotto, and also how the DNC squashed Bernie Sanders' campaign. One thing we don't know is who gave Assange the stolen emails in the first place.
Many leading Democrats say they suspect it was the Russians. They released an analysis from a private cybersecurity firm that had said it was the Russians.
But Assange claims
our source is not the Russian government, and it is not a state party.
So this is where we stand today. The public still doesn't know who provided the emails to WikiLeaks. Meanwhile, Assange is still running WikiLeaks and still releasing documents. In March 2017, he started publishing documents from the CIA's Center for Cyber Intelligence called Vault 7.
The CIA, the agency charged with finding and keeping our top secrets, can't keep its own secrets.
As long as Assange has a connection to the world, no government secret will be too far from exposure.
Julian Assange is still in the embassy. Maybe he'll leave, maybe he won't. Kind of regardless, his work has been done. He's changed the way people think about their governments, about their own secrets, about their own hackability, and really the world has changed because of him.
When it debuted, the 4G wireless we have today allowed people for the first time to hit the road and explore unknown places with only a smartphone for directions. When 5G arrives, it could enable driverless cars to take us there as well. 5G stands for 5th generation mobile networks or wireless systems. It's insanely fast and can accommodate a lot more connected devices. But the reason it's being called revolutionary is because 5G will allow connected devices to speak to each other as well as people.
Right now we're living in a world where really it's a one-way experience.
That's Bloomberg tech reporter Ian King.
The network talks to your phone, you look at your phone and access data, then you send something back to the network. What we're being told about 5G is that really for the first time we're going to see machines communicating with each other over mobile networks in a meaningful way.
5G could end up being 100 times faster than what we have now, with speeds that could reach 20 gigabits per second. In plain English, that means downloading a full-length HD movie in seconds. 5G will also increase total bandwidth, which we will need in order to accommodate the growing Internet of Things. We're talking about the class of devices like internet-connected refrigerators, thermostats, dog collars, but 5G will enable many, many more.
Things like your utility network, factories, where machines are just sat there not connected at all. Suddenly they're all going to be connected. Suddenly we're going to be able to have real-time monitoring. Other things like cars, like utility poles, like your light, the light poles.
But perhaps the biggest advance will be a huge reduction in communication lag time, known as latency. A network of driverless cars will need the speed of 5G to ping each other multiple times per second to avoid collisions. Near instantaneous data transfers could allow doctors to perform surgery remotely with a robotic scalpel. So how will all this work? First, you need to improve network density.
And that's just a fancy word for saying you put more towers out there. What we're being told is that's not actually the case with 5G.
The idea is 5G will not only use the existing mobile spectrum, but also tap into higher frequencies called millimeter waves. Millimeter waves can carry more data, but only travel short distances. This may mean you'll see a lot more of these base stations around town. And the new towers may have as many as 100 antenna ports, compared to about a dozen on 4G cell towers. So when will we get 5G? Getting 5G ready is expected to cost providers $275 billion over 7 years in the US alone. Look for the first 5G service to pop up in big cities sometime in 2019.
People think of Vladimir Putin, they think of capital P, power. And that's exactly the impression he creates. Whether it's physical power, firing different weapons, riding in various James Bond-esque modes of transportation, or tossing hapless opponents in judo. Or political power, ruling his own country with an iron fist, crushing his political opposition, or, most recently, being accused of meddling in foreign elections for his own benefit. This is how Vladimir Putin went from a poor, tough kid in Leningrad to a KGB spy to the very symbol of modern Russia. Vladimir Vladimirovich Putin was born in 1952 in Leningrad, which is now St. Petersburg. His father was a factory foreman and his mother a homemaker. It is widely said that Putin's public-facing tough guy persona can be traced back to him getting into fights when he was younger, which paved the way for him to take up judo. After getting a law degree from Leningrad State University, Putin joined the KGB Foreign Intelligence Service. He spent 16 years in the KGB. When Putin returned to Russia, he began his political career.
He went to work for Anatoly Sobchak, who was then the mayor of St. Petersburg.
That's Leonid Bershidsky.
I'm a columnist at Bloomberg View.
Putin thrived in Sobchak's administration because
he was sort of considered pretty efficient city official at that time. He was very loyal to Sobchak.
So loyal and efficient that
he was noticed by Yeltsin's close circle.
And those people soon brought Putin over to Moscow to work in Yeltsin's administration, where he quickly climbed the political ladder.
Then, of course, he was promoted to Prime Minister of Russia.
That's Dmitry Trenin.
I am currently director of the Carnegie Moscow Center.
Around this time, Yeltsin and the people around him, the so-called family, decided that Putin would become Yeltsin's successor. And then this happened. The apartment bombings were carried out in 3 Russian cities, killing 293 people and injuring more than 1,000. Putin immediately accused Chechen separatists for the bombings and followed it up with action.
He was credited with having a very successful military campaign against the terrorists.
And it worked.
After that, he became an heir apparent in the eyes of the Russian people.
3 months later, Yeltsin resigned. And on his way out, a famous exchange.
He was getting into the car in the Kremlin, and the last words that he addressed to Putin before getting into his car was, "Take good care of Russia."
So Putin took over as president, and 3 months after that, won his first election. But just because Putin won the presidency, that didn't mean he had all the power. This is Michael McFall.
I was U.S. ambassador from 2012 to 2014. In the 1990s, there was a fire sale of all the things worth owning in Russia, and certain people,
the oligarchs,
did better than others in that fire sale, sometimes called privatization, and those people tended to be well connected with the Yeltsin regime, and they weren't Putin's friends. But they probably miscalculated, thinking that they could easily find a way to influence him. It became impossible almost from the start.
From that very moment, there was warfare between him and the oligarchs.
That's when Putin gave the oligarchs a choice. Putin's way?
Some of those people from the 90s managed to figure out a new way of dealing with Putin and have survived.
Or prison.
Others could not find common vision, and so they lost their assets.
Khodorkovsky once was Russia's richest person, worth $15 billion, but he ran afoul of President Vladimir Putin and spent a decade in prison.
With domestic power consolidated, Putin focused on restoring Russia's global influence.
Putin is the guy who believes in the expansionist Russian state. Georgia and Ukraine and all the other Soviet republics that split off when the Soviet Union fell apart, he still believes that they're traditional Russian satellites. A lot of his strategy is about keeping them in the orbit. That Yeltsin line, take good care of Russia, that's how he understands it.
And he used annexation and invasion, as well as oil, gas, and trade to keep former Soviet republics in Russia's orbit. In 2008, Putin's 2 terms were up, and he decided to step down as president. Dmitry Medvedev stepped in as president, and Putin went back to prime minister. But really,
Putin never left power. He pretty much continued running the country, and Medvedev was a bit of a figurehead.
There was actually a period of cooperation between Russia and the U.S. that benefited both countries during Medvedev's presidency.
Because Medvedev did not have the same negative attitude towards the West as Putin did.
But when Putin came back to run for a 3rd term, in the lead up to the 2012 election, it was widely believed that both the presidential and parliamentary elections were rigged, and Russians took to the streets. Putin blamed the protests squarely on America, and more specifically, Secretary of State Hillary Clinton.
He believed that she had sent, and this is his words, a signal to demonstrators.
Still, Putin won by a huge margin and set about crushing the protest movement immediately upon his return to the Kremlin. Over the next few years, Russia's economy tumbled. Putin annexed Crimea, leading to sanctions. The price of oil fell drastically. The ruble hit a new low, and America played down Russia's influence, with Obama calling Russia a regional power. Despite all of that, Putin's approval rating remained sky high, and then an opportunity for payback.
I think I'd get along very well with Vladimir Putin.
In 2016, there was one candidate who called Vladimir Putin very smart.
Trump exhibited tolerance towards Putin's actions annexing Crimea and similar views on NATO and sanctions.
Secretary Clinton didn't support any of those views.
Even though Putin denies any wrongdoing,
U.S. elections.
Yes.
the the U.S. has accused Russia of being behind the leaking of 20,000 Democratic National Committee emails, which many say helped Trump beat Hillary Clinton in the presidential election. Which leaves us here, with the possibility of a President Putin until 2024, positioning Russia to be the world power he always imagined it should be.
Jack Ma is Asia's richest man and most recognizable business tycoon. He's the chairman of Alibaba, China's e-commerce giant and one of the 10 largest companies in the world. Yet he still wants more.
We know where we're going. We want to be the 5th largest economy.
Big words from the man some call Asia's Jeff Bezos. He's confident, he's charismatic, and he's definitely not the average CEO. This is how a poor school teacher went from the classroom to being one of the most influential multi-billionaires in the world. Ma was born in China's southeastern city Hangzhou in 1964. His parents were traditional musician storytellers. As a teenager, he started to learn English from foreign tourists after China opened up in the late 1970s.
And then for 9 years, Jack Ma hung around outside the Hangzhou Hotel, which is now called the Shangri-La. He would get up at 5 a.m. to talk to travelers.
That's Bloomberg technology reporter Lulu Chen.
And I cover China Internet for Bloomberg.
Ma failed China's National University entrance exam twice before being admitted to local teachers' college. He graduated in 1988. He applied for 30 jobs and got rejected, including from the fast food giant KFC.
When KFC came to China, come to us say, 24 people went for the job. 23 people were accepted. I was the only guy.
Then Ma got a job at a local university and taught English there for about 5 years, earning just $15 a month. On the side, he started a translation company with several friends. During a company trip to the US in 1995, Ma had his first encounter with the internet at a friend's place in Seattle.
I searched the first word beer. I don't know why, because it's easy to spell, baby. And I see beers from Germany, beers from USA, beers from Japan, but there's no beer from China.
So he searched for the word China instead and still couldn't find anything. And that got him thinking. He wanted to build something that would put China on the world's map.
He started China Pages, a Yellow Pages-like website, but it didn't take off. Then Ma joined a government agency in Beijing to help set up a website. By 1999, the internet stock boom had gripped Wall Street, and back in his Hangzhou apartment, Ma decided to try again. With his wife and a group of friends, Ma raised $80,000 and set up Alibaba, a site that allowed businesses to sell stuff to each other.
人家美国人强就强它的硬件，强就强它的系统建设，这方面确实比你早。但是玩信息玩软的，中国人的脑袋绝不比你们长。我们在座的所有人的脑袋绝不比你们长。
By 2000, Alibaba had raised $25 million from investors, including Goldman Sachs and SoftBank.
He had no business plan and zero revenue, but his eyes was very strong eyes.
In 2003, Alibaba started Taobao, a platform for individual sellers to trade with each other, and publicly declared war against eBay, who had started to make a foray into China.
Jack Ma has this famous saying that Alibaba is a crocodile in the Yangtze River.